The futures are open. Let's take a look and see what we've got going. Start with the S&P as we always do. Going the wrong way. Let's zoom in. It's up a little bit, but not doing too much. It's kind of coming down from its opening spot. Not a ton of volume yet, which is kind of normal with the futures. But to me, it's nothing. It's flat, which is good because that shows that there's still not a whole lot of fear. We've got a few big events coming up. Earnings season is underway now. We had the banks going this week. I'm going to be talking about that. There's a few more that need to report. I think Bank of America is one that reports on Monday, and there's a few others, but a bunch reported last week. What we saw was kind of what we were expecting. They cut down the investment banking section, so there's been a lot of progress made there. I mean, what happens when money is cheap? Speculation is rampant, and people start dumping a whole bunch of money into the markets, into stupid investments. That's like 2021 right there. That's what happened. Everybody was dumping stuff into this stock, this crypto, and it was all not going, or it was all going really well, no matter what you did. And that's because there was a bunch of money for speculative trades. I mean, it was coming out cheap. Now that interest rates are going up, that money's not so cheap anymore, so people aren't going for it, and that's what you're seeing in the investment sector of wealth management. So that's actually a positive sign for inflation. We want to see that come down quite a bit, but it's not everything. It's only one piece of the pie. So we're kind of watching that, but we have to be careful and not put too much emphasis on any one specific data point. What you're looking for is a group of indicators. Like if you've seen anything, hey, Salome Fishby rating, what's up? Thanks for the raid, buddy. I appreciate that. Hey, check out Salome Fishby's channel. He's playing Splinterlands, putting some awesome sci-fi on. Like if you really want some entertainment or you want something to listen to, you're tired of music all the time, which actually I am, like I listen to so much music, I just burn out on it. Check out his channel because you can learn the game, you can see what he's doing, see the moves he's making because he's actually really good and he wins most of his matches, and you can listen to some cool sci-fi. So check it out, Salome Fishby on Twitch. It's twitch.tv/Salome Fishby. You're welcome, man. I'm glad to have you here. We checked out the S&P, so let's check out the NASDAQ. It's doing the same thing. It's up. It's a little green, which kind of makes sense because the NASDAQ's been hit a little bit harder. I mean, most of the stuff in the NASDAQ makes up the S&P 500. There are tons of overlapping stocks there. But because the NASDAQ has more of these tech stocks and some more of the speculative ones, you're going to see it get hit a little bit harder as I go the wrong direction. Bitcoin, what is it doing? It's hanging out. Ooh, 21. Look at that. We're above that 19 level that we've been sitting at. It kind of has been doing this. It's been going between like 18 and 20, maybe 21. This is definitely a support level right here, which I'm not surprised by because we originally had 20K as the all-time high. And that lasted for years before it wasn't broken until I believe 2020. It stalled coming up to there too. It wasn't just like it went straight up. It took a while. It got to like that 8 to 13K range. It stayed there forever. And once it broke that, and went up to the 20K range, it just blew right through because there's not a whole lot of resistance there. I mean, very few people were buying at 20K at the end of 2017. It's like the people that bought there were in a ton of pain and probably still remember it horribly, considering they bought at the top, and somebody has to do it. So we looked at the futures, we looked at Bitcoin, everything's kind of just trading sideways, which is to be expected. We're going to have a lot of stuff coming up, so volatility is really, really going to pick up, and that's what you got to be ready for. The Fed meeting's coming up on the 27th, which isn't that far away. Let me go ahead and pull the calendar up. So yeah, this week, next Wednesday is when the next rate decision is going to be, and that's going to be big because we've had a lot more pressure towards the upside of those rate hikes. We've been seeing every time we get close, some data points show us that they need to tighten a little bit harder, which is what they're going to do. And they really like looking at the CPI. So yeah, the CPI was 9.1% and the estimates were 8.8%. So it's significantly up, but that's to be expected. I was really expecting that to happen considering these things, number one, they're lagging indicators. Number two, the effects of the Fed have to take time to ripple through the market. It's not like instantly everything stops. It has to dry up one link at a time. If you've ever seen this video of somebody dropping a slinky while it's like fully pulled out, it kind of like comes up from the bottom and floats where it is until the pressure like hits the slinky and then it falls. And that's kind of what has to happen with the market. Like the Fed has basically let go of the slinky at this point, and the forces within, all the links in the chain that are still sitting at their level working the way they're working, have to wait for the link before them to be affected. So they're going to be one at a time cutting through these links until we finally start seeing some downward pressure. So the fact that CPI was higher was completely to be expected. I actually was very happy that it was higher because that means that they're probably going to have to tighten harder. But the one thing that's really good about this, people are getting overly bearish, and that's what I've been waiting for. When a market goes down, at first people are skeptical. They think, whatever, this is a dip. This is just a nice buying opportunity. Hey, and Ash and Phoenix, how's it going? Hey, if you want to check out some cool gaming streams or learn about programming, check out Ann Ash and Phoenix. That's twitch.tv/AnnAshenPhoenix. And he has some great content. He's an interesting guy. Go give him a like. Go check out his stream. I highly recommend it. Thanks for coming in and joining us, Ashen. So what was I talking about? Oh, yeah. So the numbers. People are getting overly bearish on everything, which is to be expected because that's kind of what people do. There's a saying in options trading that implied volatility is always overstated, basically meaning the risk is always overstated. So people want more money to take that risk. But if you apply that philosophy to the rest of the market, you can say that's what people do. If you're looking at any of the financial media, they're looking for clicks. They're looking for views. They're trying to make their money elsewhere. They're not making their money they are making their money in stocks, but that's not the thing that they're going for. They're trying to create general trends with their fear or their positive stories, but usually right now it's fear. It's mostly fear. They're trying to fuel this bear market, and anybody with a lot of money is trying to fuel the bear market. Why? Because you don't get opportunities like this very often. This is amazing. All right, I've been trading for about almost 5 years now, and I've never run into a bear market that lasts more than like a month or two. It's really quick. A lot of times they only last a week, 2 weeks, and the dips aren't that strong or on that strong down. So it's nice to have something that's a gradual trend, something that I can buy into slowly over time. Let's see. All news thrives on conflict. You're 100% right, Phoenix. That's exactly what they're trying to do, especially in the market. And what's interesting is the market news bleeds over into the public. So some of the public stories you're seeing, some of the fighting that's going on is actually driven by forces that are trying to move the market. Not everything, but some stuff. And it's subtle, but people don't always notice it. And that's what they want. They want to push the market down farther, which I'm actually completely in favor in, man. I want this thing to go down even farther. I want this thing to crash so hard that nobody wants to be in it anymore. We're kind of getting to that point, but it's still not quite there yet. So what do we got here? Never trust the news as a general indicator for cultural health, as it shines a lens on the negative and shades the positive. Yeah, that's the thing. If you see something on the news, then you know it's not common. That's what people don't understand. They think, oh, the world's going to hell, everything's crazy. No, everything you're seeing on the news, you're seeing because it's not common. If it is common, they wouldn't be showing it because it would be boring. So they're showing you the extremes and making you think that the extremes are everywhere. And that's influencing your decision, anywhere from politics to the market to life in general. So you have to look at life the same way you look at trading. You have to have an open mind, put your own opinions aside, and let the information come in freely. All right, be ready to change your opinion or be ready to hold your opinion as well. You don't always have to change anything. You know, there's the people that say, oh, you got to change all the time. Like, no, change if better information comes in, but you don't have to change everything. You got to keep yourself strong enough to have a foundation, but not so sturdy that if something really big comes along, you're not able to move or bend with it. And that's the philosophy that I'm trying to adapt in trading more on. I want to keep my political bias aside, keep my market bias aside, and go with my brain and my gut and all the stuff that lines up together. So that's what we're looking for. See, there was a book, The Murder of Something, or rather Vance. I can't remember the name and it kills me, but there's a line in there that essentially means if the lie is more profitable than the truth, print the lie. Yep. I like that line. That's completely true. It's all like I said, it's all about clicks and views. It's not about actually displaying the truth and telling you what's really going on. It's more they're selling you a narrative that's causing you to do something. And what is that something? That something is either watch, it's click, it's continue to watch, or it's buy these products or make these investments. You know, there's always an agenda. So you have to take that in the back of your mind. It's good to consume financial media because you're going to get good information in there. It's not all a bunch of trash, but there's a bunch of trash mixed in with it. You know, it's like people that pan for gold. They don't find a ton of gold anymore. But if you sit there and pan a good spot, eventually you'll find something. You'll find some little flakes or some little nuggets. You know, it's like I've been watching some gold mining YouTube channels. So, I mean, I guess that's why I got that that reference right there. But it's true with the market. That's what you got to do. You just have to watch things. You just have to be ready and grab the little nuggets of information that are actually beneficial to you, which there have been a lot this week. Let's see what else. It hasn't been that way in ages. There was a time in the 90s where the news showed you information for you to decide your own opinion. Yeah, that time is long gone. I mean, That's the good thing about the streaming and the new version of what media is becoming. The media is becoming individuals. And obviously there's still the old tricks that those things never die. I mean, those forces have most of the resources, so they can do this kind of stuff. But it's good to have individuals with decent little bits of information that they can put out around the noise so that you're still able to get it. Before this era, there were only a few media companies that you had to go through in order to get your message across. So if they didn't like you, you weren't on there. And I mean, there were ways of spreading it. There were underground things. There were lesser known networks. But until the internet, individuals, any person didn't just have that power, which, yes, I understand there are downsides to that too. I mean, that's the whole thing we're talking about with censorship. Like, how far should people be able to go? It's understandable because it's a difficult question. Now we're in an era where not just a few people are using the internet. Like, it was much freer when everybody could just do whatever they wanted on the internet because most people didn't care. So it didn't raise enough of an issue to be a problem. But now that everything's on the internet, business is all done on the internet, everybody talks on the internet, it's so necessary for every little thing that they have to have the discussion now. There are too many people on there not to have it. So it's a rough conversation, and our species is going to get through it at some point, but it's going to be a bumpy road. That's what happens. There's no magic cure for anything. We're all here on this planet, and we have to figure out how to get by these problems, how to solve these problems on our own. And we do. That's why we got to this point in evolution. That's why we have the society we have. Like, yes, there are problems with it, but if you take a step back and look at how amazing the human race is, we've accomplished a lot. Our species is actually very incredible. Yeah, there's a lot of dumb people in the world, right? I hear that all the time. Everybody's dumb. Everybody's dumb. I actually kind of disagree with that. Like, there are dumb people, yes, but I think people are smarter than we give them credit for because we're attributing our own biases to their opinion. So they have some opinion. We have biases based on that opinion, so we apply a character to them. We don't know if that's actually who they are. That's just one piece of who they are, but we're applying the whole thing. And we tend to think, oh, everybody's stupid because there's all these people with this one opinion. Yeah, well, maybe that one opinion has some merit in a different perspective. If you're looking at something, like let's say there's a bunch of people looking at a mountain, right? One side is sunny, one side is shady. And if all the people on the shady side are going to be saying the mountain is shady, they're going to be coming around. And when they meet people from the other side that have traveled over, they're going to tell them this is how it is all around. And the people from the sunny side are going to say, no, this is how it is all around. But really, it's shaded on one side, sunny on the other. It depends upon how you're looking at it. And that's the same thing with any political opinion. You have to take a step back and look at it from a way that shows the merit in the opinion. Because most opinions have some merit somewhere, some little nugget of truth. As much as you may hate the opposing opinions, they're there for a reason. If they've persisted throughout society for years, decades, centuries, millennia, whatever it is, there's some kind of merit in it. Because basically, everything is subject to natural selection. All right, I'm getting a little philosophical here, but ideas are subject to natural selection as well. Like, we can protect ourselves in some way with our medical advancements, but we're not protected from everything. We're still a part of nature, and we're still at the mercy of things we can't control. So we haven't stopped evolution or any of that stuff that people like to talk about. We're still changing, we're still going, but we have some protections. Ideas are starting to get the same treatment. We're putting them in an arena and making them battle against each other. Yes, there are people that are trying to suppress ideas and make their own ideas the way that everything works, but the good thing about natural selection is eventually good ideas win out when it comes down to it, when it's necessary. Like, our species survived horrible, horrible times. You think about, like, somewhere around 10 to 12 to 14,000 years ago, there was supposedly the Younger Dryas, right? This huge event that wiped out a bunch of life, made it very hard to live on the planet. There are still signs all over the planet of this thing. But our species survived that. People lived without food for long periods of time. People weren't able to get clean water, whatever it was, and they still survived. Those are our ancestors. We have the ability to adapt when times get tough. And times are getting tough right now. And not just for us physically, but in the idea space, in the digital world, in the theoretical world. That's where the battles are taking place. And that's where natural selection will eventually win out, whether people like it or not. You can try to push a narrative, but if your narrative is inferior to the truth is eventually going to win. Yeah, we might destroy ourselves, but that's what people have been saying the whole time. It's always the end times. Everybody says, oh, it's the end. It's going to be end soon. All this stuff. I can't see how humanity will continue. Yeah, every generation has said that for the entire existence of society. We're going to be okay. Implied volatility is always overstated. All right? Don't get caught up in the mess. Keep your mind open and keep your eyes on the prize. And that's what we're going to do today. We're going to use that energy to take a look at stocks and see where we can make some money. All right? Because that's what I've been trying to do. We've got opportunities coming up. I've been sitting on the sidelines for a while, but it's time to get back in there. If you've been paying attention to any of my broadcasts, that's what I've been saying for the past month. I'm sitting on the sidelines. I'm waiting for something good. I made little stupid trades here and there, but I'm waiting for the hot time that's coming up right now. It's about to get really, really hot. We've got the Fed meeting. We've got earnings season. We've got the heart of earnings season. And then we've got how everybody's going to react to what the Fed does and what earnings season says. Because the companies that report are going to affect the Fed's decision on the 27th. It's not set in stone yet. So everybody that thinks, oh, it's done, we're going to be doing this right now. No, we've got time. There's still time for things to change. It was looking like the Fed was going to vote on like a 50 to 75 basis point hike, and it was somewhat divided, right, based on the data that they were seeing so far. But when the CPI came out and it blew the water out, it was way higher than estimates. That made it more likely that they're going to increase higher. We're thinking 75 to 100 now. I think there's a very, very, very low chance that they go with 50. I mean, they could if some really good signs come up. Like if energy, oil specifically, which is the top of the list of inflation, comes way down, that could affect their decision. They could back off the 100 from there. I'm thinking right now, as it stands, it looks like the odds are a 75 basis point cut or a hike, in my opinion. All right, we're looking. Some people are saying 100. I saw someone else saying 125, and I was thinking, nah, they're not going to do 1.25% hike in one meeting. No, it's not. Unless something was really, like if CPI came back at 18%, then yeah, maybe they would. But right now, no, they're not going to hit it that hard. What people don't understand is this affects people's lives in a real way. These rates are changing the way people do business or are able to live their lives. For example, the housing market. The more these rates go up means the more the banks are going to jack their rates up and charge people that are buying houses. So people that had money to buy a house a year ago when mortgage rates were somewhere in the threes aren't able to afford the same houses up in the 5-6% area. Now, when they crank rates up next week, how high and how much damage is that going to be able to do to the buyers? So what you're basically doing is the higher rates go, you're pricing more and more people out of the market, which means that people selling homes have less demand. So there are fewer buyers to buy their houses, which theoretically should cause them to drop the price. And that's kind of what happens. That is what happens pretty much every cycle we have. Now, there are people that think real estate is just never going to come down. And I would point them to 2008. I mean, yeah, we don't have those same systemic problems, but we have other things that are similar, right? They really regulated mortgage-backed securities and things like that, collateralized debt obligations, all the stuff that messed with the system in 2008 got heavily regulated. But it's been changed since then, right? So they're trying to find ways to do these same things, but in a way that's less risky. And I don't know if they really can make it that much less risky. Like, I think they have, because they're still doing the same kind of stuff, but it's not as blatant, it's not out there, and it's not as highly weighted as it was before, because people put way too much weighting into these mortgage-backed securities, and then when the loans didn't come through, everyone was defaulting, they didn't have the source of income to keep it going, so they have to prepare for that. Hopefully they're hedging it with something that will keep it from systemically crashing. And the other problem with 2008 was so many of these loans all matured at the exact same time. That was the whole story with Michael Burry in The Big Short. He was able to see that tons of loans were due in the same period of time, which is why it was so bad. Like, there are always defaults, right? People are going to have problems, not be able to pay their loans back. But the question is, how much does that happen? Like, what percentage of your loans are going into default? And usually it's not a lot. The profit they make from the other loans usually cancels out whatever doesn't happen from people defaulting on their loan. So if you get to a point where more people default on their loan than you can make up for with your gains, that's when you have a problem. Right now, I don't think we're going to have that same problem. What I think we're going to have is people being priced out of the market because jobs are still strong, wages are still high, so people still have money. Spending has gone up a bit. However, it's at the cost of savings. So savings has gone down. Like, spending has stayed steady or moved up, and savings has gone down. So that's telling you that the economy is still strong now. But the people using that money, if that runs out, where's the next source of income? And how much weight do we have to give this to see what will actually happen to the economy based on it? So I'm watching the housing market. I'm watching the investment market, which is drying up like crazy, and that's a good sign. Speculative investments is what's bringing stuff up so much, so we want that to come down, and that's what the Fed is thinking. They're thinking, number one, you got to deal with rates, get all this speculation under control because it's driving things crazy. Two, we need to wind down the balance sheet so these stupid companies that didn't use their money properly can go bankrupt, and they need to. I hope they do. If they actually do eventually go bankrupt, then we can clear some of that stuff out of the system, some of the stuff that's giving us problems. And that's kind of the problem with the Fed policy over the past few decades. It just keeps plastering over the holes in the wall. It doesn't let the stuff fall out that needs to fall out, which is really unfortunate. Hey, thanks for the sub, Ashen Phoenix. Woo! All right. Making progress here. That's awesome. It's been an interesting week. I'm glad to have everybody here. I'm glad to keep this going. So we got big numbers this week. The main thing was the CPI that was higher. We talked about that. The PPI, which is the Producer Price Index, that was higher as well. It was up at 1.1% when the estimates were 0.8. The prior was 0.9. So you're seeing inflation systemically. That whole transient narrative is a kind of a laugh now. I mean, it's so stupid that, well, okay, it's not stupid because normally you don't want to do anything. They were hoping that would clear itself out like it normally does because things back up and then they get fixed and they clear out. And it's not overnight. It's a wave that goes up and down slowly. So they were hoping that this would clear out, but we've got prices high everywhere. I mean, when inflation was first going up and people were talking about it, if you went to the supermarket, you really didn't see a whole lot in the way of increases. There were certain items that were up, but other stuff was kind of the same. Now we're seeing increases pretty much across the board. I mean, some stuff hasn't been affected because certain chains like Costco, they were smart. They had their own chicken farm. So when there was a meat shortage, a chicken shortage, it wasn't really affecting them because they were producing their own stuff in-house, which made it way easier for them and harder for the people that were trying to get it from the commodities market, basically. So there are some people that were smart and they were hedging. That's what the U.S. is trying to do right now. For example, the CHIPS Act. You know, I'm sure there's a whole bunch of political stuff that's being pushed into that bill because there always is. You can't get something good without a bunch of bullshit in there because that's just how politics works. But if that provides funding for domestic chip production, that's going to be beneficial for our tech companies. That's also going to be beneficial for when places like China shut down like they have been, because their shutdown policy has caused shortages in all kinds of goods. So being reliant on foreign goods is decent in some ways because it allows you to pay less. You can save money and still get quality and, you know, get enough quality to be passable. But when times like this happen, then you're screwed because you don't have any other source to get things from. So if we can domestically produce things, that at least holds some kind of value for these companies like AMD, Intel, stuff like that. So we're looking at that. Inflation is high. The retail sales numbers came in strong. Those came in on Friday. So what was it? The estimates were 0.8, but it came in at 1.0. The prior was negative 0.3. Also, consumer sentiment came out again. It was 51.1 when the estimates were 49.9. If you remember from the last number, they were way below the estimates. People were so bearish on the market. And even though they're still bearish, because like a 51.1 number is not strong, but it still shows you that they were above estimates. So there are some people that aren't so bearish on the market, like me. I'm really not, like, long term, I'm not bearish on the market. Short term, yes, I am. I'm bearish until all the headwinds that can cause this stuff are cleared out. Number one, the Fed. Number two, the Ukraine war. Number three, general inflation, amongst other things, right? But those three main things, as long as they're out there, the Fed is going to crush rallies. Rallies are going to get tamped down. They're going to run, and then people are going to realize they can take their gains and move on. And they will. That's just how the market works. There's no way to make things perfect and stabilize prices so that everything stays the way it is and nobody ever gets hurt in any way. No, that's not life. This is just how it works. Sometimes you're going to get burned, which is why you don't put too much into a trade. Everything you do, you have to make sure you're using money you're okay losing. You don't want to lose it. It's going to suck to lose it, but if you do, you're going to be okay. And that's how you should roll with any investment plan. Like, make sure that whatever you're doing is okay if it blows up. That's life. Things are going to blow up sometimes. I've never blown up an account fully, but I've had positions completely derail before. I went into this company that was supposed to go live. It was a SPAC, and it was during the time when SPACs were going crazy. I know it's dumb. A lot of people lost money in SPACs, but this one was looking good, and I was using a percentage of my money that I was okay with. Now, it was a heavy percentage of my money because if this thing took off, I was going to make a lot, like life-changing amounts of money. But it didn't end up going. Literally last minute, another contract came in and crushed the whole deal. I had options, and they all went to zero.
My shares were okay enough because I had been averaging down to close to where the buy-in price was. And usually with SPACs, it's around $10. Because if they disband and you put money in before, you'll normally get your money back at that $10 mark, which is why when something gets crushed, you'll see it go down to around $10 and float there. Maybe it's down in like the mid or high nines, or maybe it's a little bit above 10, whatever. It's still in that area because that's where it dissolves at. And there are a ton of SPACs dissolving. There was the famous one, Bill Ackman. He's always on CNBC and all these channels. His SPAC got crushed. They had to disband it. Everybody is getting crushed that isn't good. So I wrote something down that kind of made me chuckle, but it's true. Anything good is good right now. And what that means is if you're looking at this as a buying market, as I am, you're looking at the good companies to get at a discount. That's why the good companies are good to buy. Even though they're going to continue to get crushed, most likely, your investment is going to continue to go down until we clear things out. Even if we have these little mini rallies, at some point, it's probably still going to go a little bit lower or stay where it is. But you have to be okay with that because eventually the rally is going to come back and you're going to say, I wish I bought in at those times. You know what? But what was going on at those times? You were losing money and you didn't want to do it anymore. You wanted to give up on trading. That's what people do. That's what I did. I thought that many times. When I lost out on that position, that SPAC, I lost probably about a third of my entire accounts, or like all of my accounts put together. I lost about a third of my money. And it was a heartbreak. I literally thought about quitting. I did for a while. I think I took a couple of months off. I just didn't look at the market. I didn't think about it. Anytime those thoughts popped into my head, it was like a nightmare. I couldn't deal with it. But at some point, I got over it. I got back on the horse, and here I am. Because this was before I was streaming. Now I'm streaming about this. And if that kind of thing happens again, I'm going to bring it on the stream and tell you about it. My pain is going to be beneficial to you. And that's what I want to do. I want to make sure anything good I have, I share with you, and anything that hurts, any of my pain, anything that destroys me is going to be a learning experience, not just for me, but for you. And that's important. You need to learn from other people's mistakes, other people's pain. That's why I say don't take trading advice from anybody. All right, I'm just spilling out my opinion here. I'm not actually a financial advisor, and I'm not going to give you any real financial advice, meaning I'm not going to tell you what to buy and sell. I am, however, going to give you my opinion on things and tell you what I'm doing so that you can make your own decisions and hopefully learn something from that. That's the way it should be. Like, make sure you are empowering yourself. That's the point of investing. Never just go and take other people's word for it. Like, if you want to get a financial advisor, good, but be involved with them. Like, let them deal with the details, but have them tell you what they're doing and make sure their plan makes sense. Because if you agree with their plan and they know more than you, that's a way better deal than trying to do it all yourself. Because they have knowledge and things you've never even touched. Like, I really don't do anything with Forex. I rarely do anything with futures. Bonds, I don't really do anything with bonds. Like, you name it. I'm mostly just options, stocks, and crypto. Right? Long investing, short-term trades, some swing trades, stuff like that. But if somebody came in and knew more than me and could do everything else plus what I could do, and they would just say, hey, this is our plan, I could use my judgment to look at that plan and say, cool, I like it, go for it. And then they can deal with it, and I don't have to deal with the heartache. So that's a beneficial thing. So I would, if you have enough money and you are willing to do that, I think it's great to get a financial advisor, especially one that's a fiduciary. That way you're covered. But you still need to know something yourself, right? You need to have them tell you what they're doing and to make it make sense. That's why I think even if you're going to have other people manage your money, you should still be knowledgeable enough to make your own decisions in some cases. So right now, what we're looking at is a market that is waiting for the Fed. Oh, look at this. So just in case you didn't know, up here on the top left is the currency map. Right now it's a little down, which kind of matches the market. So let me go to the ES. We are looking at a 3-minute chart. So it basically opened up, came down to this spot and sat. So we're sitting flat, which makes sense. People are waiting. That's what you should be doing. You don't really want to be making huge moves right now when volatility could be strong. Because here's what we're looking out for, right? So earnings season has started. The banks came through and they reported well enough. They, in a rising interest rate environments, the banks are going to make more money. Why? Because they charge you more money. Like, what the banks do is they take money from you and they put them into higher yielding investments than what they give you for it. So they're basically just profiting off the difference. And as interest rates goes up, that spread grows, so they make more and more money. Therefore, when you see earnings from banks like this during these times, they're probably going to be up, which they were, which is a good thing. Hey, MacMaster1, thanks for the follow. Appreciate it. If you got anything you want to talk about, throw it in chat. We'll get to it in a little bit. So right now, we're looking at the E-minis. right? Everything's flat. People are waiting for the Fed announcement. Earnings season has gone through. The banks reported, they said they're doing a little bit better. It was kind of mixed. Some of them like, not so much, but a few of them, but most of them did well enough. Citigroup, they did really well. They had a nice pop. They're one that I usually like to watch because they kind of report early. They're a lower price stock and they're easier to make trades on. I mean, look at what happened. So they reported a couple of days ago, boom, they shot up because they did really well. They had some surprises, but some stuff in line as well. Some of the other banks didn't do as well. I think Wells Fargo had some problems, and that's kind of what we expected. It was supposed to be mixed because not everything's up. There are some sectors like investment banking that are down right now. So if you're heavily invested in investment banking as part of your wealth management section, then you're hurting. So some of these businesses aren't doing so well, but some of them are. However, this gave us a little bit of a preview to what's going to happen next. We're looking up some big company earnings. So let me go to the calendar real quick so we can actually see what we've got coming up. This week is the week we are on right here, where I'm kind of moving my grossly oversized mouse pointer. Wednesday, which is the 20th, we have Tesla reporting, which is a big one that I'm looking at. So Tesla, they're coming up. Here's the thing, though. The stock doesn't usually move that much on Tesla earnings because they kind of pre-announce some of their important figures. For example, delivery numbers. They announced that already, and that's one of the big things, like how many cars did they deliver in the quarter, which a lot of investors are looking at as kind of the way to measure how well they're doing. So we're going to see what their guidance is. That's the important thing that we're looking for. The numbers, I think, are going to be relatively in line, or at least in line enough to not move the stock too much, at least as my guess. I mean, anything could happen. The thing could fly, the thing could tank, but usually what happens with Tesla earnings is it releases tension and then it sits relatively close to where it was before the earnings report. So what do we got here? I swing trade the NAS futures monthly and the crypto trades during the last 5 years. Just enjoying the analysis, looking at heading back down toward 11,700 this week. Yeah, thanks. Appreciate having in there. So you're talking about trading the NASDAQ right now. Is that what you're saying? Or is there the ticker NAS? Let me go back to the charts real quick and take a look. You're looking at the NASDAQ 100. Let's just as a proxy go with the Qs right now so we can get an idea of what the NASDAQ is doing. Volatility keeps my blood pumping. Oh man, see, you got that adventurous spirit. I'm not as good with day trading. I'm more of a long-term swing trader and a long-term investor. I do make some random day trades, like the last Fed meeting. I made a really awesome day trade on the Qs. Ended up going with some options, some call options right at the bottom. Took profit in like 12 minutes or something. It was honestly one of the best day trades I've ever made. I don't usually day trade because I'm not good at it, but some people are. If you have the demeanor and the mind for it, good. Like, I respect that so much because that is not easy, man. That, like, it really is an adventure. It's like, you get the same thrill that you would if you were skydiving because things are so intense. I hate sitting there looking at my positions, having huge amounts of money invested and just like sweating, even if things are going well, you still have that fear. So that's why I like to make long-term swing trades and kind of gather things slowly at points where a lot of the volatility has been exhausted and the premium is low, because I mostly trade options. But if I can get shares, which I've been actually able to do now that the market's dropping, I'm happy with that too. Because my philosophy is trade a little bit, take the profits from the trading and put it into the long account, right? Use some of the profits to grow the account base and have more cash, but also grow the investments that are going to pick up during the next bull market. So I don't know what your philosophy is or what you're using your money for, but if you're getting in there and you're making some trades on the NASDAQ futures, good, man. Take that money. Do what you can do. Since you can't trade options here from the UK, so I invest in longer term stuff through my pension provider, but play money with NASDAQ. Try and scalp a fixed percentage every day. Ooh, scalping. Yeah, see, that's kind of what I did with the Fed trade, like just scalp a little bit. There are some interesting scalping strategies that I've actually been considering looking at. Right now, my mind is waiting for this Fed thing, and I have some ideas, some trade ideas for when it comes up. So yeah, that's too bad that you can't trade options in the UK, but you can trade CFDs, contract for difference. I was looking into those, and those seem so interesting. But what's funny is they're banned. They're illegal everywhere except the United States and Brazil, so I can't touch them. It'd be nice to be able to just take responsibility for the difference in the contract and move it based on how it moves, but I can't really do that. So I stick with options. I really don't like the risk involved in options. Ideally, I would be doing the wheel where I would have shares and I'd be selling calls on them, and once those get hit, then I'd be selling puts on those shares again and just collecting premium until I can actually buy them. But right now, because of everything that's happened with my accounts, I'm basically stuck to just going with long options, which is the odds are very much against you when that happens. I do have some shorts, so it's not all long options. I actually do sell some premium. I've bought some long puts kind of, but right now the best thing the thing that's been working for me is just selling premium on calls because everything keeps getting crushed, which we're expecting. So let's see, then invest some of these profits in longer term stuff like you recommended. Hey, there you go. That's exactly what I want to hear, man. Like, I'm an intermediate trader. All right. That's I'm gonna say that right now. Like, I don't know as much as I'm not a professional or whatever. I've been doing this for almost 5 years. I've learned what I've learned. I'm obsessed about it. I have my strategies that I like, but everybody has their own thing. One thing I have noticed though is the best if I had just done my long strategies and not traded these other things that I was trying to trade, I would be up huge right now, even with this drop. I mean, that's the power of dollar cost averaging long positions. It is the best strategy, hands down. Now, the problem with that is your account goes down when we have these drops. So if I move, let's just take a look at the SPY and move that onto the large chart. So if I zoom in a little bit, we can kind of see having a long portfolio is going to hurt you through this little drop right here. I mean, you think about it, we're 7 months into this, 7.5 months into this drop. People have not seen a drop this long in quite a while. Right? So there are a lot of panicked people getting out of this. And if you're just dollar cost averaging, your entire account is down, down, down. Every week is down. You get these little ups and you think, oh, there it goes. It's coming back. Nope, it's going to get crushed again. Why? Because we have so many factors holding it down. The reason the market rises isn't because like a couple of people got on Robinhood and threw $50 down into Bitcoin or whatever. The reason the market moves is because huge amounts of money are able to move throughout the areas that cause it to move, i.e. the big investment firms that are buying and selling at rates that none of us can even fathom. For the most part. So the money that those people are using is drying up. And that's what people don't understand about this whole interest rate thing. The Fed is trying to make it more difficult for people that can afford to borrow insane amounts of money to do that and just drive the price of everything up. Because that's what they're doing. They're going and they're taking that money and they're saying, okay, what looks good right now? What's getting crushed that we can put a bunch of money in? Then they jump into it. I mean, that's what happened to the crypto market. I mean, as soon as people with big money saw that the crypto market was moving up and making progress again, they came in and they caused a squeeze against the shorts, and they caused a huge bull run that we saw until the end of the year, basically. Now, everything is coming back because the Fed is winding that down. Now, that's not going to last forever. So let me see what we have here. Yep, but that's the COVID craziness and the Fed policy, right? Could anyone, bar the insiders, really force these insane 2 years we've had? Or foresee the insane 2 years we had. Yeah, you can't really see everything. I mean, you can predict certain stuff. If you were just kind of generalizing, you would say like, all right, we've had a crazy amount of up, there has to be some down. But there's no basis behind why you would see that down. COVID and everything that's happened since then gave them that basis. And even, we didn't see that coming from a long-term standpoint, but we were hearing about COVID a few months before everything shut down. Like I remember hearing little bits about it in December of 2019. And I was thinking like, oh, this could be crazy. But at the same time, I thought this happens every few years. There's a disease somewhere, and people freak out about it and then nothing happens. And I think that's what the public was thinking, is it's just going to be another one of those. Well, it wasn't. It was a little bit worse. And we actually had some effect on the economy and everything else because of it. So now that things are starting to pick it back up, COVID has caused the supply chain to close in weird ways. And that's the problem that we're having right now. Like when you get things going, it's not that everything just fires up all at once. A lot of these links in the chain have to wait for the link before them to be up and running because they need the resources from that link. You can't build whatever you need to build if you don't have the raw materials, and the raw materials can't get delivered if they're not getting mined by these mining companies. So there's just so much that has to happen before the people later in the chain can start their work again. That's why there's all this delay. And that's also why I think that eventually things are going to open back up, because it takes time. It's not instantaneous. If you've ever taken like a garden hose, or if you work out one of the ropes and you whip it up, you kind of see the wave move up and go down the line of the hose. It doesn't instantly move the whole hose. And that's what the economy's like. We've got these waves shooting through that have effect. But what's interesting now is we have different sources of those waves all competing. We have the negative sources like inflation, like Fed, like the Ukraine war, etc., pushing things down. But we also have a strong job market. We have a good amount of spending. Retail sales are above estimates. So the underlying factors of the economy are not bad, right? People are talking about recession. They're worried about recession. Recession technically means 2 down quarters of GDP. That's it. There's nothing, and that can happen, which I would not be surprised if when the next number comes out that it is down a little bit. But does that mean that everything is bad around that? Does that mean like when people think recession, their mind goes to like 1929 or 2008? But a recession could be like, we're just not growing as fast. Like that's also part of a recession too. It's negative a little bit, but things aren't totally shut down. and the next quarter it'll probably pop back up, right? As soon as things keep going, everything's going to return to normal. And I mean, unless new catalysts come into the market, which is a possibility, things are going to clear up eventually. So what do we got here? One of my most painful plays in the last 2 years was going heavily leveraged on short on Zoom. Oh, see, I don't use leverage either. That's my other thing, because I'll get into that in a sec. You shorted it at 416, got a margin call just above 500, and that's what I was going to talk about, was a margin call, and lost it. I lost a lot, but knew it was in the right trade. Timing is everything, right? Yes, exactly. No, you would have, if you were able to hold that longer, then you would have been completely right. I mean, Zoom is way lower. Let's take a look at where Zoom is today. It's been crushed for a while. Yeah, the pandemic plays that were really, really hot during 2020 and 2021 aren't doing so well. Yeah, look at this right here. It's in double digits, 96, right? Like you were up here. So you were shorting somewhere. You were so close, like right in this area right here. You're around 400. And this is this a weekly chart? Yeah. So if you were able to hold on for a couple of months, you would have been starting to be profitable. And if you had held on for like, almost a year, then yeah, you would have been extremely profitable. However, you got a margin call because there's only so much there's only so much spread between your capital and what they're lending you that they'll let you have. At a certain point, your collateral doesn't become enough to cover the position if you have to buy. I'm sorry, yeah, to cover the position if you have to cover. So margin calls are going to happen. That's why I don't like doing it. Even though it would be nice to have some extra cash, I just don't like the idea of the broker closing my positions or calling me and telling me I have 24 hours to add cash or I got to sell their stuff. Because, if you believed in it, like, you would have been extremely profitable. However, there's also the fees, right? So you can't just borrow shares at no cost. So number one, you have a limit on how high the stock can go before you get a margin call. Number two, the longer you hold those shares, the more the more that interest racks up. So it could cancel out your gains if you held for quite a while. But see, that's what people were doing. Like, I've been caught in those, man. I got caught in Tesla in 2020 doing that exact same thing. I was close to the peak, but I didn't quite get it. And I got squeezed out, and this wasn't margin. So I just had to close it all myself. I lost a good chunk of my portfolio. That was another one of those times I really wanted to quit, and I was just super upset about it because I thought, hey, I believe in Tesla, but it's gone up so much that it has to have a little bit of a correction. Well, I was too early on that one. So I learned my lesson. I don't short the high flyers. I'm not that good at it. What I'm better at is waiting until the hype dies down in something and letting something get crushed so bad that I know is still good and then buying it. That's kind of my main strategy. Like right now, that's what's happening to a lot of good companies. My quote earlier, anything good, is the thing that should be playing in the back of your mind right now. Get good stocks. If you believe in the market long term, if you think everything's going to be fine, which it's going to be, right? Don't listen to the pessimists. Yeah, there are negative things and you have to pay attention to them, but the pessimists are always wrong. Historically, they're always wrong. It's never different. And if it is different, things are going to be so bad that it won't matter anyway. So you might as well bet on it going long, and then if things don't work out for you, they're going to be so bad, having lost your money is going to be the least of your problems. So let me switch back to the SPY real quick so we can actually get a good idea of what I'm talking about. This is why I say, let me see if I can switch this to, no, I got to go to the index because the index goes back longer. I'm sorry. The SPY is only going back to the 90s. So let's go to the actual SPX. The SPX index. Let's switch this to maybe quarterly. Okay. So right here is why I say the pessimists are always wrong, right? It's always different. Remember in 2008, the worst crash ever. The next one, everything I've been seeing since 2008 is the next one's going to make 2008 look like nothing. The next one's going to be so crazy. The dollar's going to get destroyed. All of our savings are going to be depleted. The country's going to get taken over and everything's, it's this horrible, this mix of everything's over and it's done. It's never done. All right. If it's done, which, one day it technically will be, we're probably going to evolve out of this system at some point if we continue to go the direction we're going. Even if we do, it's going to probably be a while. So you have to just look at the positive. Like, look at this chart. You can't even see what was going on down here in the 30s, right, or the 40s, because we've gained so much recently. All right. Everywhere you see one of these down moves, there are people saying this is going to be the worst crash ever. This is going to be the worst crash ever. Every single time. Is it? No. But look at what we did get. It's a nice decline. This is exactly what I was hoping for. And not only is that a nice decline, but we've got a little bit of support here. This is kind of the area that the market has priced in the future hikes. Or I'm sorry, yeah, the future hikes and everything else. There could be more downside if things go up, because the way you're looking at how the market reacts is, what's the market thinking about the next year, basically? They think that in the future, inflation is going to be taken care of. And they're thinking that at the rates that they're at right now might be sufficient enough for the data we've seen so far. But we're going to get new data in a week and a half. So that's why I'm waiting for that as well. Because if we get really bad data, if they decide to crank things down even harder, the market could really drop on that. If that doesn't happen, then we could get a little rally right here. But the thing is, with a rally wouldn't be positive at this point, because the Fed wants to wring the towel out completely, right? Like if you take a wet towel and you wring it out, the water takes a little while to come out altogether, and you might have to squeeze it a little bit harder right at the end to get that last little bit. And that's kind of what the Fed wants to do. They want to wipe all this stuff out, make sure that people can actually afford things again. Because the pain is going to hurt while they're doing it. But once the average person is able to afford things better, and life becomes a little bit easier for the same amount of pay, then they can let the floodgates open again and start the cycle over, right? There are so many different things that were going on. In fact, I read an interesting article this week about the bullwhip effect. It's where part of the supply chain overcompensates for the demand they're getting, which then causes the next point in the supply chain to overcompensate for them, and you keep getting more and more and more. But eventually the demand dies down, and then the original retailer has to order fewer items. And that kind of goes through the chain as well. That's part of the boom and bust cycles. And like right now, we're at a point where prices are extremely high and supply is extremely high. So that is going to correct itself at some point. People have a bunch of supply. They have a supply glut that they need to get rid of. So we're seeing sales in a lot of these stores. I've been talking to different family members and friends, and most of them have some kind of a store that they've been going to recently to get a whole bunch of cheap items. Like, oh, I went to this store, they're selling stuff cheap. I went to this store, I went to that store. And that's a result of the glut. They're going to reduce prices to get rid of their stuff. But once that stuff is out of the economy, or like not out of the economy, but out of the retail inventories, then they can replace it with newer items. Because part of the stuff, the problem is that this stuff is out of date as well. So it's not just that they have a glut, it's that they have a glut of outdated stuff that's hard to sell. There are new things being made, but they're just not able to come into the system as quickly as we would like, which is why we're trying to pick up the supply chain. So let me see what I got here. I've got a few things. Let's see. You don't see the upcoming recession as being deep and ingrained one. I do, particularly with the Fed's inaction and insane policy on quantitative easing. Yes, they did take too long to do to act, and now they have to act harder than they should, which is going to cause pain. So I actually agree with you on that point. The short term, I do think, is going to be a problem, and I actually think that it's more likely we'll be in a recession than not. But I don't think that recession is going to be quite as heavy as people think it's going to, because we still have strong underlying fundamentals. So that's the part that I like. Let me keep reading your comment here. Of course, the market will return to new highs, but the numbers are terrible. I'm more of the mindset that of a prolonged, a couple of years of negative growth recession to avoid stagflation. No need to time the bottom exactly, but protecting yourself from our incapable political and financial leaders is key to making long-term profit. Yes, I agree with you right there. I don't think the recession is going to last as long. I mean, obviously, this is my opinion, so I don't really know. I'm not predicting anything completely. I don't think it's going to be as intense as people think because of the good underlying numbers, right? A bad recession would be like prices are going up and spending is down, meaning people don't have the money to buy the goods. See, that's more like stagflation also, where like prices rise and wages don't. But here's right now, wages are high. Like unemployment is high, wages are high, spending is high. So that's telling me that there are three fundamental factors for why the underlying economy could still be okay. Yes, the Fed is going to have to tamp down rates higher than they should. They're going to bring it into restrictive territory. But because of where we are, that's actually a good thing. And the problem with that is it's going to crush a lot of people, and it's going to be kind of ugly at some points. But the good part of that is that it's going to get this thing over quicker. Right. I think there's a lot of pessimists out there that think this is going to last longer than it probably will. And like I said before, this is just my opinion. Anything could happen. I'm preparing myself for any outcome. A long recession, which in my past videos I have talked about, like if you look at the 1929 Great Depression, it took like 2 decades or so to get back to those levels and above. So we in the modern era have we've not had long-lasting recessions. Our recessions are always over relatively quickly. And any dips in the market, as you can see on this chart right here, are quick. I mean, I have it on the quarterly chart right now. So you can see the pandemic drop, that one of the worst, biggest drops we've ever had in such a short time. It was 1 quarter. 1 quarter. Right. And then it started to come back after that. But it affected our lives beyond that. And what people don't understand who don't trade stocks is that the stock market is forward looking, which is why when there was that meme going around in 2020, like, oh, everybody's, unemployment's the highest it's been in forever. There's all this problem. There are all these problems. But look at the stock market. The stock market is coming back and making new highs. Well, that's because the traders were looking at 6 months to a year in the future and seeing that this stuff was going to clean up. So it's not a slight like, oh, we don't care about what's going on with people. It's actually a positive indicator for the future because people believed that it was going to come back, and it did. I mean, that's exactly what happened. The Fed's response is what caused it, not just the dropping of interest rates, because they already had started to drop interest rates after the 2018 drop, but the bond buying, right? They had never bought junk bonds before, meaning that companies with high risk could put together a bond and sell it to the Fed, and the Fed would get it. Most people on the market weren't going to buy junk bonds from failing companies because they thought, oh, well, that's not a good investment. This company could go bankrupt any minute. But the Fed was like, hey, we're in charge of the money. Well, actually, the Treasury and the Fed are in charge of the money in the United States. But for this conversation, we'll just say it's the Fed. Say we're in charge of the money. We'll buy your stuff. If you go insolvent, who cares? We made the money in the first place. So that was getting businesses out of problems. Whatever they had, they could just bundle up a junk bond. They could get a PPP loan. Whatever it was, they were able to get the money and go. Not to mention the stimulus into the public caused a mania, which caused money managers to react to that and make things even more crazy. And that's what the Fed is tamping down, that crazy upward spiral. So let me see what else. I'm missing a few things. We need a Volcker moment. Interest rates up to 7 to 9% to curb this insane inflation. Yeah, that would that would be a Paul Volcker moment to jack rates up like that from where they are. All opinions are good ones. I may be completely wrong. 2, it's just good to discuss. Good timing for 2 ads. All right, so hopefully you're back from that. So where were we here? Okay. The 7 to 9% interest rate thing you're talking about, I think that's a more of a worst case scenario. I think that at this point, raising rates that high would cause more problems than the Fed is willing to deal with right now. Because one thing they have to deal with is the job market. They're trying to crush speculation without crushing labor. And that's really difficult to do because it's not all the money that these businesses are getting is being used for the stock market or derivatives or whatever. Like some of it is going into the companies. Some of it is going to hiring new people, improving things, adding jobs, stuff like that. The argument of like how much goes there versus how much goes in the stock market is a whole different thing. But in general, there's at least some of it going into the labor market. So cutting that down is going to hurt the labor market at least somewhat. But because the labor market is strong and then underlying fundamentals are strong, businesses can still make money. And that's what we're waiting for. If things get crushed, but businesses are still able to be profitable, then we're in a good spot. We have to let the headwinds clear before we can stand up and start walking again. That's kind of what happened. Like we had this huge tornado right here, this big pump that is extremely unhealthy, actually. Like you want to see a more gradual rise. You want to see people readjusting their positions and being in positions they like so that the market doesn't continue to fall. When you have a bunch of speculators that are only there to make a little bit of money and get out, then you don't really have a floor on the market. And that's what we're doing. We're putting a floor back in. If you've ever put a little pile of dirt on the ground, smash it down, you can squish it farther and farther and farther up to a point. Eventually, it gets so compact that you can't really squish it down anymore. But that's kind of how resistance works in the market. Like you're getting all the weak hands out, but the strong hands are absorbing more and more and more. And the farther down you go, the more of those strong hands you actually run into. So that's what we're doing right now. We're packing down the dirt. We're making the support stronger so that we can take off for the next bull market. And that's what I'm waiting for. Right now, the Fed is crushing things down. We're going to get this meeting. It's looking more like 75 basis points at this point. And this is important. Depending on how much the Fed raises, the market will react in different ways. If the Fed raises 75 basis points or less, the market will be happy with that and think it's relatively in line. Some people are going to think it needs to be more than that, but the general market's probably going to be okay with that. If the Fed goes for 100 basis points, that's going to show you that they're a little bit more serious about tamping down inflation, and I'm good with that. Like I think between 75 and 100 is the place to be. And especially like Fed President Bullard, he thinks that we need to front load these rates. We need to jack it up really high right now and then taper off slowly to get to a point that inflation comes down to around 2%, which I do agree with, but I know that's going to cause some pain. Like, the Fed wants to be as gentle with this as possible so that they don't hurt the underlying economy. They want to crush the securities market without crushing the real economy. So I think that's what could happen. If they jack rates up too high, that hurts everybody. So that's why I don't think we're necessarily going to get the 7-9%. Right now, their dot plot chart shows that they're going to be about 3.5%-ish by the end of the year and maybe up to 4% by this year. However, that's the dot plot from the previous meeting, and we've had new data since then. We have a lot of Fed presidents that are talking about 75 basis points, maybe 100. They're kind of hinting at the 100, but they're not really putting it too far on the table because they don't want the market to overreact. I do. Like, I want the market to crash down as far as it can possibly go, because the farther it goes, the more I can buy, the better companies I can buy at a discount. That's what I'm looking for. I'm looking for a nice buying opportunity. I was lost in 2020 and 21. I did not do that well. 2021 was probably one of my worst years ever. But now this year's been wonderful. You know, it's so funny that, like, the worse the market does, the better I do, because I'm more comfortable in these situations. I'm more comfortable buying things when people are out of them. Trying to buy stuff in 2021 when everything was ramped, like, I don't like buying at highs. It scares the crap out of me, and all it was highs. Now, if you had just gritted your teeth and bought the highs, you would have been good for a year and a half. But now, see, this exact thing that happened this year is why I don't like buying highs, because there are so many people that bought at the end of the year thinking, the higher it goes, the more bullish people get, and the more risk they take on. They take on way too much risk, and when that comes back, we get what we had. Those are the kind of people that say the market's a scam. I don't ever want to be back in this again. It's terrible. Well, good. I want you out, because eventually you're going to come back. Those people don't realize that they are not above their biology. We are more controlled by our biology and our basic mental patterns than we realize. We think we're smart. We think everybody else is caught by their biology, but we're not. Like, everybody I've talked to has some kind of a thing like, yeah, I think everybody else is, but I'm not. I'm different. Like, no, you're not. And the reason you don't think you're different is because you don't notice what's actually happening. These people that hate the market, they want to get out, they think it's a scam, they are going to come right back in the next time a 2021 happens. It's probably going to be a while because people remember these kind of things and they don't want to deal with it. Not to mention they have no money and they have to, build up their cash pile again, which is not always easy. But when things start going up, they're going to see people making money and want to get back in. We're all sheep. We try our best to be wolves. Some people think they are, but we're all sheep in some way. The 99-cent thing, instead of saying something is $10, they make it $9.99, and that's stupid. It's only a penny less. Well, guess what? It tricks you on a very deep biological level. You see the 3 digits instead of the 4 digits, and part of you becomes less tense about it. That 1 penny doesn't matter. It's the fact that a basic part of you, instead of seeing 4 digits, sees 3. Now, mentally that that's only 1 cent, and when you're looking at the item yourself, you're adding it as if it's $10. But your physiology is feeling as if it's $9.99. So it's making it easier for you emotionally to spend that money. We all do that. We're not immune. You can kind of curb it a little bit, but those sort of tricks do work on us, and people don't realize that, which is why they get caught in the markets. You have to realize what your own shortcomings are. You're a human. You have biology that does what it does, and you can't get out of it. You can, however, tame it. You can't always fix everything, but you can make things a little better. So knowing that, you can go into these situations that we're having right now going, okay, I'm going to feel a certain way, but I need to put that aside, keep my mind open, and just go with the flow. That's what we're doing right here. So let's get into the next portion of the show here. We're talking about the Fed. My guess is that we're going to have some rate hikes. I have some notes here about what they were saying. Barkin, he's reserving judgment on 50 or 75, but that was before recent events. Daily says the economy is strong. Here you go. We're talking about recession. So the Fed's daily says the economy is strong. Consumers continue to spend. The labor market remains strong, but inflation is too high. Expects mortgage rates to come down. Doesn't expect rates to hike to extremes. More like the 3% range. So some of the Fed presidents think it's going to be a little higher. Bullard is way more hawkish. He wants it to be closer to 4% by the end of the year, which, to me, at this point in time, 4% is about the upper range of what I think is acceptable for the market. If we get a little bit more than that, I think it's going to spook institutions that are heavily reliant on that and could cause more damage than expected. So they have to be somewhat careful. And as I was saying before, the effects of this take time to come in. So we're going to see the effects of what they're doing right now in a couple of months. Now, there's no meeting in August, so we get to see what happens by the September meeting. So whatever they do with this meeting, which at this point I think is going to be a pretty high rate hike, we want to see what happens before they continue doing what they're doing. And I think that's the way to go. I mean, because things are lagging, because it takes time for stuff to show its face, you need to go slow on it and make sure that you're not overcorrecting. Because if you overcorrect, it's going to take just as much time to steer it back where you want to go. It's not like an overcorrection can instantly come back. You have to really push to get it to go back the other way. And that's what the Fed knows. If they overdo it, it's going to be really difficult to bring it back. So they don't want to go too hard with it. There's a very pessimistic view right now, but it's not that pessimistic. I mean, we've spent a good amount of time in this range right here. We're not, we could go down a little bit more, but if things stay where they are, then the Fed is basically priced in what's happened. I don't think they've priced in everything yet. I think we've still got a little bit more downside. But once we clear that stuff out and the CPI and the PCE start coming down, which are two measures of inflation that the Fed looks at, then they're going to be a little bit more dovish. They're probably not going to go as hard. So we could see a 4% target by the end of the year. It could be more, I'm thinking more like in the threes somewhere, depending upon what happens. And obviously anything could change. At this point, it's a little too early to say whether or not they're going to jack things up that high. And that's kind of what the Fed presidents are saying. They're saying, yeah, there's a problem, but the underlying economy is strong. And that's the theme that I want to bring in today. The pessimism and the bears are really pushing it, but they have an agenda. They want it to fall. Me, I don't care which direction it goes. I'm going to make money in both directions. I'm going to use the downward motion to take some profit and put it into my long account, which is getting crushed. But by the time it comes back, that long account is going to be very happy because I was buying during that time. When you're up way above your average, all you think about is, oh, I wish I bought more down there. Oh, I wish I bought more down there. Well, this is the chance. You got to grit your teeth and do it. It hurts. It sucks. But if you want that for the future, you have to do it. So let's see. Rest of the Fed. Waller sports 75 hike to get to neutral. Says he would support 100 basis points too, so we have that possibility. Everything's looking like we're going to get some good Fed action, and that's what I want to see on the 27th. I'm going to be streaming that live, by the way. That'll be 11 o'clock in the morning Pacific time. The rate announcement will start at 11, and then Jerome Powell will come out at 11:30. I'm going to do what I did last time. I'm just going to stream it from the time that the rates come out up through Powell's testimony, and we'll see what happens there. Maybe I'll make a trade. Maybe I won't. If I do make a trade, it's probably going to be on the indexes, maybe the NASDAQ, maybe the SPY, whatever's looking good premium-wise at the time. So that's kind of my move. Other than that, my cash is kind of sitting around. I'm just buying stuff that's long and saving cash for trades when the volatility picks up. So the other thing we have is earnings season. The Fed's going to be reporting right in the middle of earnings season, and this is going to be an interesting one because we just had we had a mixed earnings season last quarter, right? People were very bearish on it, but only because the guidance went down. The underlying fundamentals weren't bad. Companies still were making good revenue. They were making earnings per share close to the estimates, maybe a little bit under, maybe a little bit over, but it wasn't to the point where the fear that I'm seeing right now is justified. So this earnings season is going to tell us how companies are actually doing. And the heart of earnings season starts right around that Fed meeting. So let me go back to the calendar again. You can see this week coming up right here has a few companies. Thursday, we've got 126 companies reporting. But the week after that, the week of the Fed, there's 300 companies reporting on that day. There's 400 companies reporting the next day. And the next week, we've got, 600, almost 700 companies reporting. So this is the big part right here. This is what I'm waiting for. The cash that I've been sitting on the sidelines with is being saved for this area right here. All right, so we've got a lot of earnings coming up. This is what I'm saving my cash for. Little buys on everything else. I bought some, I've been buying a little bit in the cannabis sector because it's getting destroyed. There was actually some positive news for the cannabis sector. So let me go back to the charts real quick so we can take a look at that. If I open up, let's just go with the MJ real quick. But you get an idea because that's the history right there. It's gone down. So I've been, stacking up a little bit on these because this is more of a long-term play for me. The way I look at it, we have an election coming up in the United States. The party that's in control or mostly in control might be losing some of their seats. So they're going to be looking for issues that are broader. Politics in the United States have gotten very niche. Like the fringes have kind of taken everything over. So we're going really hard down the fringes and not really grabbing that much of the middle. So the middle is open for whichever party decides they want to advertise to it. And the middle is cannabis. Stuff like cannabis is popular right there. Oh, CPI or CP lie. Oh, I get it. I get it. Okay. Yeah, you know why? That's funny you say that too, because the way they measure the CPI has changed over the years. Like back in the 80s, they switched it to a longer moving, a longer time moving average, so it doesn't move up as fast as it should. Because so they're saying inflation's like 9%. It could be like 12 to 15% or more if you measure it by the old standards and use a shorter term moving average. But using that longer term moving average actually it's negative in some ways because it cuts out what a little bit of what real people are feeling, but because it's a longer term average, it's harder to move up or down. So if you see downward movement in that moving average, that's a really good sign because a lot of weight has to pull it down. However, the way they measure it is a little off. So take it with a grain of salt. Like I think 9.1% is still a fair measurement. It's not like these things are all scams, right? They're like, I used to kind of believe everything was a scam and everything was a conspiracy and all that. And I'm sure that stuff like that goes on because people are going to do what's in their best interest, and different interests are going to collude. It's just part of life. It's what you do to make life better for yourself. But how extreme that is and how much reach that has, I have no idea. So I look at it as people try to do their things, they make their influences on it, but there's a lot of reality that they can't control that will come in with the influence that they're trying to make. So you can see some influence, some of it's not so obvious, but a lot of what goes on is just people being people. And that's what these measurements tell us. Things are difficult right now, but people are holding on, at least somewhat. Enough to where I'm not as worried about what a recession means. Like whether we're in a recession or not does not matter at all. It just doesn't matter. It's all talking points for politics. What matters is how people are actually living, how businesses are actually doing, and where the money is going. Like, I don't care if GDP slowed down enough to be negative for 2 quarters in a row. Fine. That's what happens with every chart. Look at any chart, right? We were just looking at the SPY. Let's go back to the SPY. Does the SPY go in a perfect upward trend? No. Look at this. From the dot-com boom all the way to the 2008 recession and past, we stayed in this trading range. Essentially, if you bought stocks somewhere in the 90s, you didn't have any gains until like 2010 or 12. That's when things started to go above where you bought in. In recent years, we haven't had that long of a drought. So we're not used to that. But that's what happens with everything. If you measure any kind of data over time, you will see that it's not a perfect line. It goes up, it goes down, even if it has a trend. So this S&P has taken a long time to get where it is, but look at how high it is. I mean, this index was so much lower decades ago. And if you wait long enough, you'll be up. But if you go through one of these long-term sideways or downward trends, it can hurt. And people that have gotten in recently, i.e. me, it's like I got in during this mess, right? Like I think this was about 2017 or so. Like once this started to happen and crypto was pumping and all that, that's when I started getting into it. So for me, all these dips have been really slow. I've had like 1, 2, 3, 4 real bear markets in that time. Well, I should say 3 real bear markets because these ones right here, this is kind of a bear market, but not, that was more a response to the China trade war than anything else. This was a bear market for sure. And the 2018 is when people don't talk about. And that was when they jacked interest rates up to 2%, 2.25%, 2.5%, right? You think about, oh, that was too high. That 2.5% was too high just 4 years ago. So what are we talking about? 4% in 1 year. That 2.5% in 2018 took like 3 or 4 years. I think they started in like 2014, 2015. See, this decline right here, mostly I think was because there was an election coming up, a very contentious election in 2016. But there was also the start somewhere in this mess of rate hikes. They went very slow. They did like a quarter point at a time or less. And they took years to get to 2.5. But when they got to 2018, they started slamming rates up harder. And the market didn't like that. So now we're at a point where they're doing that to an even higher degree. That's what I'm interested in right now. I want to see how this plays out because this is different than what we've done before. It's more extreme. It's the same thing. It's just more extreme. And that's why I don't think a recession is going to last as long as people think it does. I mean, or maybe a recession will last for a while, but I don't think the pain of the recession is going to be in the economy for as long as people think. And I definitely don't think it's going to be in the stock market for as long as people think. It's going to be volatile for a while, yes, It's going to be painful for a while, yes, but inflation is still rampant, and that's how the market goes up. Money enters the system, goes into the markets, the derivatives market, the stock market, the bond market, the Forex market, you name it, and things keep going. That's how we get the upward pressure. If you're inflating a balloon, you need to continue to add air to make the balloon bigger, and that's what we've done. Ever since 2008, we've turned the money spigot on to an extreme degree and only turned it off for short periods of time. And that's what we're doing right now. We turned the spigot off in March. So that would have been somewhere around here. This rally was the squeeze after the first interest rate hike because people thought it was going to be worse than it actually was. So that's why you have to pay attention to this stuff. And that's why I say don't get too bearish. Because if you're too bearish, you might go in too hard on a short and get squeezed out. And I mean, look at how the market dropped. I mean, as it was going down, it didn't have the same reaction as it did earlier. I mean, we've had these big bounces. These are weekly candles. So you can see this bounce right here was about 3 weeks. So we had, pessimism for a couple of months. Then we had this bounce for almost a month. So we'll say about 3 weeks. And then another decline. So anytime that the shorts were getting in here, they were getting in heavy, but they were probably getting squeezed out before this nice red trend right here. And during this red trend, I had every single week somebody coming into the channel and saying, it's going higher, it's going to bounce. You just check, it's all-time highs in a couple of weeks. Every single week. And I was telling people, why? Give me a reason why that should do that. The fuel for that fire is not there, right? If the fire doesn't have enough oxygen, doesn't have enough propellant, whatever it is, it's not going to explode. It needs those factors. It needs some pressure. It needs some oxygen. It needs some fuel to really explode. And we're not going to have that until the Fed stops tamping down speculation, until the Fed stops winding down their balance sheet and forcing companies to actually deal with their problems again. We've got a very heavy market to overcome. And I do think we're going to overcome it. The question is when. And for this whole time, I've been saying we got to wait until the September meeting because they're going to jack up the rates during these three, right? May, June, July. They've been jacking up rates and they're going to keep doing it. And that's going to put enough pressure on the market to push it down. Once that's relieved, I think we're going to have an extreme bull market because people want a bull market. They don't want to be sitting here stuck in this bear market forever. Yes, there are bears that love it. I'm kind of happy about it because I'm able to make the kind of trades I like to make, but eventually it's going to turn around. So the question is when. And here's what I've been noticing, right? So I wrote in my notes that analysts are starting to agree with me a little bit. I don't like that because that means that there's a good chance that the trend could flip, right? As soon as people start saying like, hey, there's some long-term possibilities, the bears are going to start getting squeezed out. But we're so uncertain right now that it's not worth even jumping in until we know what the Fed does next Wednesday. So my plan is I'm going to do the stream this weekend. I may or may not be on a stream next Sunday. I'm not sure, but I'm going to be streaming the Fed meeting on the 27th, and I'll probably be streaming the Sunday after that to recoup everything. We'll have to see. It's a busy couple of weeks, so I do want to be on, but it's also a lot of work, and I have a lot of stuff going on in my life, so we'll have to see how that goes. So right now, I'm worried that there is a possibility that we could bounce. I want this downtrend to continue for at least a couple more months. My thought is towards the end of the year, floor could form, and we could bounce off of that, but we'll have to see if everything goes together the way it should. It all depends upon the data. I mean, if you're looking at the screen right now, you can see these moving averages have all been tipping downward. Like the longer term ones, they're not so bad, but these shorter term ones are all going down. We're very much looking like it's going to continue to be a bear market. So the Fed is what I'm waiting for. Company earnings is also what I'm waiting for, and I'm keeping most of my cash on the sidelines until I see a trade during that volatility. I want something priced incorrectly. So if you're looking at specific stocks or specific indexes, I like the SPY and the QQQ because they will have reactions during the Fed meeting and after. They'll have a reaction more online with the trend. Any individual stock can go crazy in any individual day, but the indexes take a lot more weight to move, so I like playing them with options on a directionality type play. So that's what I'm going to be looking for during the Fed. I want to see some extreme pessimism before Jerome Powell starts to speak. I want to see all that stuff get pulled out of the market, and then hopefully I'll be able to buy into something that looks good and ride the pump. Because what happens is there's a bunch of tension that builds up in the market before an event. That tension is what you see being released when the event happens. Perfect example was the last Fed meeting. We had this huge downward movement, and it kind of stopped. And it couldn't go down any farther, and it exploded after that. And the point that it started going up was when Jerome Powell said, we are in line with your estimates. The market kind of has a general consensus of what they think should happen. Everybody's got their own opinion, but the average opinion of everybody put together kind of forms a consensus that you could look at. And that market sentiment is what the Fed is catering to. They're trying to cut down the things that are causing inflation, but also keep the confidence up of people who are trading and investing so that we continue to move the markets in a positive way. We don't have these huge crashes and we don't have these huge bursts. So any rally we get right now will probably be crushed because interest rates are going to keep going up for a while. The balance sheet's going to wind down continuously. So I'm looking at any bounce we have as an opportunity to short, or any dips we have as an opportunity to add, which is kind of what I've been doing. So let me get into a few things here. The only trade that I've made in the last 2 weeks is Rite Aid, my good old fashioned short. You know, I love shorting Rite Aid because it's just kind of an easy one for me. They're not the worst company in history, but they have some problems. And that's why when we get these little spikes, like you can see this one right here, I actually made a nice little short on this one and I took it off this week. So I waited through. I actually might have done it on this red week right here, but I got a little bit of this action and then dumped it the other day because they were up far enough and I wanted to take some profits just in case we get a little rally or something. What happens right before the Fed could be so different. Sometimes there's a whole bunch of panic the week before, and then the 2 days before the Fed meeting starts, there's kind of a calm before the storm. Other times there's not much of a reaction, and then those 2 days before the Fed meeting become extremely volatile. Either one of those scenarios can happen, and I would actually kind of prefer if the volatility happened right before the meeting, because then you know a lot of those shorts and a lot of the weak hands have been fleshed out, and the bulls are sitting there behind the gate ready to go. And I want to be able to ride that wave when that gate is opened. So I'm looking at hopefully some downward movement before the Fed. Now, if we get upward movement before the Fed, that's a different scenario. I'm less comfortable with that because that tells me that the market thinks the Fed is going to price whatever in and there's not going to be any surprises, which means the market would get complacent. That would be a scenario where I probably wouldn't touch very much because I'm not sure what to do in that scenario. Normally, it's the other scenario. We get selling beforehand. And that's healthy because once the Fed says, hey, we're going to do exactly what you think we're going to do, then traders go, oh, good, I can buy again. And the wave starts. That tension is released. That's what we're building up. We're building up a whole lot of tension. So no matter what happens with rates, there's going to be some volatility on the candle, like the 1 minute, the 5 minute, whatever candle when rates are announced. They're going to digest that for the next half an hour. And then Jerome Powell coming out and talking is going to be what drives the pump in the next direction. Okay, so my notes talked about the Fed. Oh, here we go. Now let's get into some individual stocks. There were a few interesting plays this week. Gap reported. They had actually reported a while ago, but they said that they're going to be doing even worse because they have a glut like everybody else does. They got hit a little bit, but they kind of ran into a little bit of a wall. They went down, but not all that much. Like bad news is already so baked into this stock and a lot of other stocks that I'm actually watching it now. I think once they get rid of they have an Old Navy glut. They ended up buying the sizes on the edges way more than the sizes in the middle, but unfortunately their sales come from the sizes in the middle. So once they clear some of that stuff out and get some new inventory, then things will start flowing again. At some point, they're going to look good again. And it's not just this company, basically anything in that square. In fact, let me pull up. Look at how volatile that is. I like that it's down at the bottom of the range. It's down below the point of control. So most people that own this company own shares at around $19 or $18. So this being at $8 is a nice opportunity for the future. Any stock that's good enough and is like this is worth looking at. Now, they're not a stock that I would want to own long term. This is more something I'm looking at for a possible trade. I did buy some leaps in it already, very small. Like I'm starting super small positions. I'm not really going heavy into it, and I'm buying leaps for like 2 years in the future. Because who knows how long it's going to take for this stuff to go. And if things continue to go bad, the leaps are actually really cheap right now. So my cost basis is low enough to where I'm not worried about losing everything. Because having 2 years on your contracts means that you're good if the stock comes up even a little bit. The farther out the contract is, the more it benefits from high movements because you're getting in at a good price when people don't want them. So I'm just looking at stocks like this. And if you look at this, let me zoom in a little bit more. I'm not that much of a technical analysis guy, but I do like standard deviation channels and moving averages. And right now it's kind of coming up to that. The standard deviation for this stock looks like it's around $25. if you're looking at the historical range for the stock. The point of control is more somewhere around 18 or 19. So most people are in this range, and it's low enough to where the chaff has been separated from the wheat, and most of the weak hands are out of this. It's like the true believers that are in it now, as with most stocks. So when you see this kind of stuff, and you can go into a company, like you can go into a Gap, you can go into an Old Navy, you can go into a Banana Republic, which are all stores that this company owns, and take a look at how they're doing, which is why I like companies like Rite Aid. I can go in there, I can see how they're doing, I can see their finances and their filings, and it's easier to follow than some startup that I've never seen before and doesn't have any history. And the other thing is, bears are going to be pessimistic on good companies that aren't going to die. So they're going to provide some fuel for the upward motion, which is what I love. I want to see negative reactions, because you know who matters? The commercial traders. So there's a report called the COT report. It basically shows you commercial traders are bullish right now, and they're starting to buy at record levels. The public is bearish right now, and they're shorting heavily. And normally, the commercial traders are the ones that end up being right, mostly because they have more of the money. So it's kind of a self-fulfilling prophecy that they're going to push the market in their direction. But at this point, when everybody is getting super bearish and they're shorting heavier, commercial traders are starting to flip around, kind of like me. That's why I've been buying. At the beginning of the year, I was really not buying. I was thinking about it. And then as it came down, I started like kind of getting into it a little bit, but not too much. But now that we've been hitting these levels, my buying has picked up. I would say I'm at like a medium pace of buying now. I'm not like dumping huge money into anything or anything like that, but my buying is picking up, and the lower it goes, the more my buying is going to pick up, until my buying money is out, which will happen at some point, because usually when these downtrends last for a while, you run out of bullets before the bottom. It's just kind of how it goes, and you have to be okay with that, which I am. I'm super okay with that. I mean, as long as I can get a good price, I don't have to get the whole bottom. I'll be happy about it when the next bull market comes and everybody else's average is up at the highs and mine is way, way down. So that's kind of what I'm looking at right now. I'm looking at what the overall market's going to do, how companies are going to report, and I'm looking at what the Fed is going to do, most importantly. Because the other headwinds, like the Ukraine war, that one's less certain. If you wanted to see what's going on with the Ukraine war, this map shows you kind of what they've been doing, and it makes sense right here. So Russia's over here, and they're kind of trying to get themselves a land bridge to Crimea. How far over are they going to get? Are they going to take the rest of this? I have no idea. But strategically, this is a very important spot, and this is what they're trying to get. I think they want to expand this a little more. These little regions right here are showing you where they're kind of expanding. But if their objective was just to get this and maybe grab some of this section right here, the war could be over sooner than we think. But I don't know what their idea is. I have no idea how long this is going to last. So this kind of thing I'm putting on the back burner because it's less certain. So Russia, they're going for their objectives. Last I heard, they had met most of them, but there was still one or two that they didn't quite have down yet. So I'm not as certain with that one. The other thing that's hitting us right now is inflation. So you can see with this chart right here, this is showing you specifics of what's going up right now. So number one, gasoline. So these are from June. So a little bit lagging, obviously, but the most recent one we have. I actually really like these where inflation is and isn't charts because it shows you what's going on here. But gasoline, you've been hearing lately in the news, gasoline has come down. Yeah, the oil index. In fact, real quick before I get to this, if I pull up crude, let's go to the crude futures real quick. You can see that this decline is actually pretty substantial. You know, there's a lot of political motivation by people talking about the oil markets, but if you're looking at it from an open-minded, non-biased perspective, this is a nice drop. However, we've got this little green candle right here, which is the opening of this week, so I'm not going to put too much weight into what's going on right now. I mean, look, there's no volume down here, so this doesn't mean anything. But we've had a substantial decline. We're coming back to the moving averages. We're also coming back to the standard deviation channel. The standard deviation median range is somewhere around $64 for oil, and right now it's up at, what, 94? So, and it's come down from, 120, 130. Where did it peak? It peaked at 130 like a few months ago and then kind of had a double top almost. Is this going to continue to go down? I don't know. I think it's going down because people are securing other sources of natural gas, other sources of oil, whatever they need, besides the Russian oil production, because Russia produces a huge amount of oil. Now, the U.S. isn't as affected by the Russian oil ban as other places because Russian oil made up like 3-ish% of the United States oil. Not a lot, right? But we've also ramped up domestic production. There are other companies in other countries that have ramped up their production, trying to find places around Russia to get that oil. So this is an opportunity for these companies. Because here's the thing about oil companies. They're extremely indebted for the most part. There are big companies that are really good. You think like Chevron and all that. They've got way better balance sheets. They can handle their high dividend. I think Chevron has like a 7 or 8% dividend, which for most companies would be very difficult. But because oil is so unattractive in the long term, they have to do something to keep people there, and that high dividend is it. However, they can manage it. And right now, with prices being so high, it's benefiting them. But who it's really benefiting are the littler companies that have been struggling for years. The companies that are so in debt and have trouble paying it back that their stocks have been crushed. So them being able to pay things back and being able to up their production is in their minds a great thing, because they can get back in the game and they can actually make money again. But this drop in oil is, number one, because all commodities are just kind of coming down right now. Things are starting to pick up a little bit. We're kind of getting used to the world as it is. We know that there's this conflict in Russia and Ukraine, but as things evolve around that, we're going to have ways to avoid the pain from that. But we're not going to be able to avoid all the pain, because Russia and Ukraine are huge countries. They're huge exporters of a lot of food, a lot of energy, and you just can't make that up fully. But it is an opportunity for all the other companies around to pick things up. And I think it's going to shake up the supply chain in general, because people are going to think, do we really want to go back to Russian oil, knowing that once this war is over, they could start another one? Like, let's just say they stop and they keep their little land bridge to Crimea and say, that's it, we're good, we don't want anything else. People would still have in the back of their minds, what if they decide to take the rest of the country later? What if they decide to expand to other places? You never really know. So that's kind of something that we've grown to get used to in the rest of the world now. We know this is a thing. We know it's causing problems, and we're doing our best to get around it. And that's kind of what the market is thinking too. They're like, all right, other companies have opportunities here, so it's not the end of the world, which is why oil has come down a little bit and may continue. I'm not sure if it's going to continue. It depends upon how well things go. This earnings season will actually be good, because it'll provide oil companies a chance to provide future guidance. And as I've said, the two main movers of stocks that you know about are, one, guidance, and two, analyst actions. Price targets, analyst upgrades and downgrades. Those move the stock. So if oil companies come out and say, hey, we've got production going like crazy, we found these new oil fields, we're going to be good for the future, that could fix the market quickly. That could cause a rally right away, because oil is one of the main reasons why things are going down. People don't realize how heavily oil is weighted into the market. I mean, oil is so necessary for so many things that even if you hate it, you still have to realize that most of what you do is made possible by oil. A lot of the energy production, materials, all different chemicals, not to mention, fuel, a big one across planes, cars, whatever. There's just so much. Even as we transition to greener energies over time, there's a lot to overcome. It's not just going to happen overnight. It's going to take decades, not just years, decades, to move to other sources. Because number one, oil is in so many things, and it's so convenient for what we're doing. And number two, development still has to improve in the green sector. We can't take the demand away completely with what we have so far. So there's still room to grow. Green has to improve. It has to take market share from oil, and it's going to have to do that by having the best ideas. It can't just do it on a political motive, because if the politics say we need to do this, but the science doesn't back it up, then it's not going to be able to win out in the long term. You need science and opinion behind you in order to affect change. And that's what's happening with the green market. It's slowly becoming more viable. If you think about 10, 15 years ago, we didn't run a quarter of the stuff we run on clean energy now. We've made huge gains, but those gains are minuscule in the grand sense of how much reach oil has. So this is going to take a while, and this downtrend isn't going to be permanent. We're going to have some waviness. We're going to have some choppiness. At some point, there's probably going to be another spike. There's probably going to be some more declines, but if you look at the long-term trend, oil is up, and it's going to be up for a while. It's been going up since 2020. This was right after the pandemic crash. We also had a panic in oil to where oil went to negative territory for like the end of one contract cycle. And ever since then, it's just been up, up, up. So we have momentum behind it. Yes, it's come down a bit, but I don't expect it to continue forever. I expect more choppiness and either a continued uptrend or maybe a sideways trend before we have a decline to more reasonable prices. And reasonable in the standard deviation sense would be somewhere in like the 60s. And there's a saying in the oil market: the cure for high oil prices is high oil prices, because that causes people to stop buying as much. It causes people to look for alternatives. So oil has to compete. So even though they are the dominant market energy share, they still have to compete with anything else, because if they become too expensive, then other forms of energy gain. So they can only become expensive enough until their competition starts to get an edge on them, which naturally pulls that down. So there is kind of an ebb and flow to how things actually run. All right, so I wanted to pull up that graph real quick because we're getting towards the end of the stream here. So back to the graph. So as we can see, inflation is mainly centered in gasoline. That's a huge, even though it's come down, that's a huge percentage of what's going on with inflation. And as production continues to ramp up, and as the number of barrels of oil OPEC is allowing to flow into the system increases by the month, we're going to see things come down, because this is just too good of an opportunity for struggling companies to not heavily sell. It's like Bitcoin. When Bitcoin was really high, there was incentive to take profits because people were had been in it for so long, they were way up. And now there's even more incentive to sell for the miners because they need to continue funding their operation. So there's always a give and take to everything. It's not just Bitcoin. It's all markets. So this gasoline section is in the same boat. They're going to have people that come up and undercut the competition a little bit because they're still making a profit, and eventually things get saturated. We're in a cycle, and it's just at one part. It's not the whole thing. So expect this to continue to be volatile. So the other thing is airfare. Now, airfare is an interesting one because we've had some bullish movement in the airlines recently. The government either passed or is going to pass a bill that gives some money, some infrastructure money to airlines to improve runways, get new planes, blah, 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 stuff like that. So that hopefully will be beneficial to the airline industry and maybe drop prices a little bit. The other one, household energy, that kind of to me goes in with gasoline. Energy as one sector here. You can see these are individual sections of it, but if you're looking at any type of energy, you're kind of group it together because that's how the indexes trade. So even if they are doing different things separately, the indexes are going to reflect the total of these companies anyway. So the other thing we have is transportation, which is somewhat in the energy spectrum, but it's also because prices are high right now. It's chips are in short supply. Not as many new cars can be made as demand is asking for. So there's upward pressure in those prices. Then we can go down furniture, food at home. Like you can just see everything's up right now. However, I think it's kind of interesting that rental cars are in the negative territory right now. Same with IT hardware and services, because right now is one of the biggest expansions in technology we've ever had, but it's not in the same way as it was during the dot-com boom or what you saw after that. I mean, people are moving over to the cloud. Life is changing. Everybody's got AirPods and a phone and this. The Internet of Things is going up. There's just so much that's going to require IT and hardware and chips and things like that. So I think at this point it's low, but it's probably going to pop in the future, which is why I've been looking at tech companies. Like I actually bought a few shares of AMD the other day. It's been down in the 70s. I've been waiting for it to come down for a while and actually have some extra cash to buy some. So like I had that company at 19, 18, something like that, and I let it go in the 30s. It went up to it went up to like 130, 140 or something like that. So it's better to hold some of these things. And I've been waiting to get into AMD again. So I bought in a little bit this week. Yeah. So yeah. Anyway, this is what I wanted to show you. This graph shows that we're still kind of high in the energy section. We're still kind of high in the food section. There's a long way to go, but we have been making some progress. I mean, this drop in oil prices isn't nothing. Yes, there are people that are arguing about the politics of this, but from a market standpoint, this decline is a good thing. And you look at where it declined to. Here's the interesting thing. So this is more of the technical analysis. We had a huge volatile move right here, confirmed by heavy volume, and you can see that was the trend for that point in time. But since we've relaxed, where did we come to? We came back down to this point where people were getting a little bit consolidated. Like shares were right here is an important point because you have high volume and you have not a whole lot of price movement. So that tells me a lot of shares changed hands. Not to mention, look at the volume profile. You can see over here, this is where a lot of people bought into their shares. So as it coming down to this point does not surprise me. These are the speculators. All right. When you see huge candles like this, like you see somewhat of an area of support or resistance forming, and then you see this giant shot, and every candle after that is just really long and really volatile, that tells you that there are speculators in there. So the speculators really, really started to jump in about here. So that would have been somewhere around February, which, that was when the Ukraine thing started to go. So the speculators came in high volume, caused everything to go crazy. Now that we're kind of seeing a stagnation of that, a little bit, and it's a little bit more uncertain, and certain things have already been met with that war. Not to mention, measures have been taken to alleviate the pain for people around this market. It looks like things are cooling off a little bit. Is it going to stay there? I don't know. We're back at resistance right here. So that doesn't necessarily mean anything. We could break through and have a panic, but my guess is it'll consolidate in this range a while because that's where a lot of the shares are, and then probably keep either going sideways or going up a little bit until we have some relief from that market. Even if it goes down a little bit more, I do see that there could be some continued sideways or upward motion. In fact, we have a little bit less volume in this area, and once it gets down here, down to the 40s or 50s, if it does, that's where your huge support areas down here. This is where a lot of people bought in. So I could see it falling down there. But with the political atmosphere, this is kind of where it's going to hang out until the next catalyst happens. So we're just waiting for whatever catalyst is going to move the oil markets, if you're trading oil markets. Which, Kajichi, I missed you. I'm sorry, man. Hey, thanks for coming into the chat. This is an important day. So we talked about the banks. We talked about the COT report. We talked about a couple of stocks. We got Tesla earnings coming up. I'm going to be watching that, even though I don't think much is going to happen. I'm going to see what other companies are reporting. Let me check my list real quick. There we go. Next week, the companies we have coming up. So right now, what I'm looking at are these companies right here, because these are going to be reporting mostly this week, maybe a little bit next week. So yeah, American Express, Bank of America, Carvana. Was the one at Abbott Labs at the top. Biotechs. I'm not as good with biotech, so I probably won't do anything on that. It's just interesting to see what they do because they're a part of the market too. Domino's, that one can be really volatile sometimes. I'll watch that for sure, but I'm probably not going to play it. It's had this nice bounce after such a big decline. It's not really what I like. I like to get stocks when you see them real red like this here at the end, when they've been dropping for months and people hate them. That's when I like to get into them. So this one's already had a bit of a rally. I don't really want to touch that. Goldman Sachs is reporting. They're one of the more important banks, one of the bigger investment banks. Halliburton, don't really care. Interactive Brokers, don't really care. IBM, this one I could do a little bit. So the technology sector, I'm looking at. I don't like that it's already come up a bit, so I'm probably not going to trade it, but it's a good indicator of the sector, so I want to keep an eye on it. Johnson & Johnson, they're kind of a multi-thing play. They're at their highs. I'm not going to do anything with that. KeyBank, another bank. Netflix. Now we're getting into something that I'm actually interested in. So Netflix, this chart right here, let me show you. If you wanted to have an Apocalypse special, what would I say that is? I would say a chart that looks like come on, I can't move. There we go. Trying to do this one hand is so difficult. A chart that looks like this. This is what I like. I want a chart that has been destroyed on a decent company. And Netflix is a decent company. They're newer than some of the other companies I trade, but they're established enough to where I like the chart. At some point, they're going to have a rebound, right? They were overdone because everybody went too into the streaming pandemic close down plays. But now that, their true colors are showing, they've lost a lot of subscriptions. Their content has gotten a little stale, so they have to invest in other things. Competition has gotten so much heavier. There are good shows on so many different platforms now. It was that Netflix was the platform that owned all the good shows. Netflix was the place you went. It just kind of became, remember the whole meme Netflix and chill? It wasn't Disney Plus and chill. It wasn't Discovery Plus or whatever else you got, Paramount Plus. It was Netflix and chill because Netflix was the thing. It was kind of the original. I mean, it wasn't the original, but it was the popularization. Netflix popularized this whole thing. They have that nostalgia value a little bit. They also have some real value because they're still the same company they were when people were bidding them up here, but all the speculators have been driven out and people are not confident. It's down in the hundreds. I could see this coming back up. The median is somewhere around 300. What does that say? 352, 354, somewhere around there. Yeah, that's way above where it is right now. So if this goes down any further, because they have earnings coming up this week, I'm going to be so happy. If this drops even lower, I'm going to be buying options on it. But my guess is most of the bad news has been baked in. There was a drop from their last earnings, and there was also there was an announcement after earnings too. So they had this huge, this was when they lost 200,000 subscribers basically, which had not happened to them for a while. They were growing up until this point. And afterwards they said around here, hey, we're probably going to do even worse than expected. And that may have been a way to drive more of the weak hands out. So when they do actually report, things come up a bit. But I don't really know. So, but that's what I like. I want so much negativity into the stock that it's overdone. And it might be at these levels. I don't know if it is. It could have more downside. I'm being really careful with it. But look at how long it stayed at these levels. Ever since earnings, it's basically stayed in the same range and hasn't gotten any lower. What has the rest of the market done? It's gone down. Let's go back to the SPY and take a look. SPY. Even though we had that rally on Friday, we kind of had a flat week, really. Not a whole... Like, let's go. Yeah, see, the week was down a little bit, but it wasn't really flat. But look at this whole time, the market's been going. Actually, I guess it's roughly the same. Netflix was kind of cool down when this was going on, and there was all this jumping around, and it stayed where it was. So I like that as a possibility to get in for the future. Am I going to trade that? I don't know. Maybe. It really depends. If I see some serious weakness, like if before the Fed meeting comes out, everything drops, that to me is the perfect scenario. Huge drop before the Fed meeting. I'll be looking at a company like Netflix that's already destroyed and getting destroyed even more below what people consider fair value. So at this point, if you look at this trend, if I go back to Netflix, NFLX, you can see that this trend it's support. Basically, it's packed down dirt. It's kind of hanging out in this level. It's got some volume on the volume profile, so shares have changed hands there. It's a good looking spot for a bounce if things improve. But the question is, are they going to improve? I have no idea. I personally think there's more downside coming up. I don't think there's as much downside as other people think because we have the strong underlying factors. But any day now we could see a bounce. Really, after the Fed meeting, I think there's going to be some relief and there's going to be a release of tension. So we might have a rally. How long that rally lasts, I don't know. But I'm not really going to believe the rally unless the Fed tells me that things are better than we thought. Because the market's going to go on what the Fed says, not necessarily on reality. See, that's the thing about trading. Trading is all based on the hype. Right? If you look at day trading or you look at anything that goes on, hype is what moves the market. There's going to be some event, people are going to overreact to that event, and then eventually they're going to see the results of that event over a longer period of time and go, oh, okay, this is actually not that bad. Or actually, this is worse than we thought. Whatever it is, the time will show you, time will tell. And that's all you have to pay attention to. But the hype in the moment can oversell or undersell anything. So that's what I want. I want some serious downward hype. I want the tension to relieve when the Fed speaks, and then a rally to come after that. And I want to benefit from that rally. I'm not going to ride that rally fully. I'm going to take whatever gains I can get from it. I'll probably, if I trade anything, it'll probably be on the day because after the Fed, things have been going down more. That first Fed meeting that they raised interest rates like 0.25% or so, we had a nice 2 or 3 week rally, maybe longer, because there was so much built up tension and it was a small rate hike. Now we have a better picture of what's going on and we know that the Fed is going to tighten hard. They've already started that cycle. So what they do next week is, to me, the most important thing that's coming up, and that's why I'm kind of sitting around on the sidelines. I'm looking at things like Netflix. I'm looking at the indices and seeing what they're doing. Where is that thing? So what else do we have in this? Sam Adams Boston Beer Company. So yeah, the alcohol sector. Constellation Brands already reported. They did well enough. I think they guided down, but their numbers were fine. So I mean, I'm guessing Sam Adams probably going to be about the same. Schwab, I don't care about. Snapchat. Here's another one I'm really interested in. So Snapchat for me has been one of my best trades. Like Beyond Meat and Snapchat have so much hype, so much volatility, and they have products you can actually look at and experience that I like them as trades. They don't have giant floats. Well, Snap actually has a giant float, but it moves as if it's a low floater. Like, look at these moves right here. These were gigantic, right? This was an earnings season where it came up to its debut price, its IPO price, which is why I put this little line here, because up until that point, which was a few years, this was the price to beat. And once it went above that and squeezed all the shorts, it had some huge moves up. And mostly because people shorted the hell out of it. It's not a bad company. It's not the best company ever. I don't know if it deserves to be quite up here at this point in time and at this level of inflation in the market. But I do think it's better than people are expecting, because one of the problems right now, TikTok. it's taking market share from every social media company. It's the new hot thing, and it's not that new. It's been around for years at this point. And I'm at the point in my life where I don't get on the trends right away, but I'm finally starting. Like, I made a TikTok account for this the other day because I want to start posting all kinds of other content. Part of the reason why I'm doing it every other week is so that I can start making videos to put up on YouTube, on TikTok, on other social media platforms, so I can make some posts, so I can interact with people a little bit more. So that's kind of what I'm thinking with all that. But getting back to Snapchat, I like the chart because this is an Apocalypse special right here. A decent company, decent enough, I'm going to say. Snapchat's not perfect, and they do have a lot of competition, and their product isn't that much different from anybody else. They're also calling themselves a camera company. So, you know, they're not, oh, we're not social media, we're a camera company. We make hardware cameras. Yeah, you do, but I mean, the product is the Snapchat app. That's the big thing right there. It's not the fact that you make cameras. You know, so they're still a social media company, but they've had a lot of negativity priced into them. And if the market continues to go down, it looks good. But look at where the price is sitting right now. It's actually sitting at the point of control, which is where most people have exchanged shares. You can see it's done the same thing that Netflix has. It's gotten absolutely crushed and gone down to the point where it's having a harder time going down farther. Now we've got earnings coming up. Snapchat and Netflix are two of the companies I'm really watching this week. If you want something that's good, that has a high probability of moving, those two companies do. What direction they're going to go, I have no idea. Could they just go sideways? Absolutely. You never know. Binary events, you know that they're going to happen, but you don't get a guarantee that it's going to go in any specific direction. You never know at all. You can guess, you can have probability, you can have odds, but you're never going to know for sure. So I want to go with something that looks decent enough. And this chart looks decent enough. Like when I played Grocery Outlet and Snapchat the first time, those were my last two really big trades, not counting the Fed trade on the Qs. That I made a good amount of money on. Not a ridiculous amount of money on. But for my return, I put a heavy amount of capital in there, and I made like 2 to 3x on these. I think Grocery Outlet Grocery Outlet might have been about 4x. Snapchat was probably about 2x. I could have had about 3x, but I held some of the contracts a little too long. Actually, I sold most of them too quickly, and then when it went up and peaked, I only had like a couple of contracts left, and I let 1 or 2 of those go. So I rode the last few contracts down quite a bit, actually. But I still made a good amount. You know, 2 to 3x your money is wonderful. You know, don't worry about how much you're making. So what do we got here? Interesting. Well, thanks. Yeah, hey man, appreciate you coming into the channel. I want to have as many people coming in and talking as possible. You know, if you got some questions, you got stocks, throw them on the table. Let's discuss them. Otherwise, I'm just going to keep blabbing about what I blab. So yeah, Snapchat, Netflix, those are my two favorites. AT&T, that's a very heavy stock. It doesn't move that much. It's more about the yield. Yes, it's better now that they've spun off the Warner division and all that, but it's still a very heavy stock. It's still, you're looking at it from more of like a long-term dividend play than a big mover on earnings. So I'm not going to be doing that. It'll be interesting to watch because I actually own Verizon, and movements in AT&T or any of these other companies like T-Mobile can affect Verizon or the other companies in the sector. So I want positive news in some ways, but also actually I want negative news because that allows me to get more shares cheaper. I mean, Verizon is already at the low end of the range. It hasn't really gone up in a very, very long time, in years, but it goes between this range of like the low 50s up to the low 60s. It's just been bouncing in that range for years. So the fact that it's low, and if it goes even lower, then I want to buy some more because I think it did dip down into the 40s for a little bit. I remember buying like a few shares at that point, but it's mostly hanging out in the 50s. So if AT&T comes out and crashes things, good. I'm going to buy more Verizon. That's one of my favorite positions. I love my Verizon position. It's one of the ones that I feel that I sleep the best at night having. It's one of my biggest positions. I don't think it's actually my single biggest, but it's probably my second biggest position. But hey, I'm fine with it. I don't worry about the decline. The decline just means more because Verizon is Verizon is a very stable company. When things go down, it only goes down so far because it has a good yield and it has a good business model. With everything coming up, you know, the Internet of Things, self-driving, the way we're interacting, my streaming right now, I mean, all this stuff is taking up more bandwidth, and internet service providers are going to become more necessary than they already are as time goes on. So they're in a good position. Anyway, so moving on. Let's see, Tesco or Tractor Supply Company. Sorry, that one I'm actually just putting on to watch. I actually haven't. I don't know this stock very well at all, but it's another company in that sector, so I want to watch it. Tesla, yeah, we're going to see that. My expectation is that we're not going to get too much from it because they like to pre-announce some of their important stuff, and then the reactions are usually relatively in line with what they do. So it's more just a curiosity thing. I'm not going to trade it. If it drops, though, here's the one thing: if Tesla drops, I want to buy some. So I got in. I had so many opportunities to buy lower. Like I remember before everything happened, when everybody hated Tesla and it was in the 200s, I thought about buying a few shares then, but I was like, no, I can do other stuff with the money. Tesla just keeps moving back and forth between like 2 and 300. It's not going to move enough to care. Well, I should have done that because, even one share of Tesla at 250 would have netted me thousands of dollars by this point. So if I had bought a few shares, that would have been wonderful. So I've been waiting to get back in. And when we had that nice dip down to like the low sixes, high fives, somewhere in there, I bought some because I thought, hey, this is still higher than I would like, but it's down enough to where I feel comfortable making a small bid on these. And that's what I did. I got to fill it a nice low position. It's been up ever since I bought it. So I bought it on a nice day, but we could see some downward pressure. And if the earnings end up being worse than we thought, hey, good opportunity for me to get a little more. So I'm watching Tesla, only really reacting if they drop. Twitter, that'll be another interesting one because Elon Musk is now officially pulling out of the Twitter deal. I kind of stopped paying attention to it. I had my play on it. I bought a strangle and I sold it way too soon. I ended up selling for like break even when I could have had like a 5x profit if I had just waited even a few days after that. So that was a big disappointment. I really should have, I was going long term on it anyway. I shouldn't have been so jumpy and gotten out of it so quickly because the gains of either of those options, the upward or the downward option, would have overcome the losses of the other quickly. So that would have been nice, but I didn't, I had puts and I sold them too early. And look at this. I bought puts when the thing was in like the low 50s, like these puts would have been so far in the money at this point. It's not even funny. So yeah, I'm kind of like, I'm a little hurt on that one. So I'm just kind of staying away, just watching it, see what happens. We'll see what they say at the earnings conference. United Airlines still has to go. American Airlines had a good quarter. They guided up. They said, they said they're making a bunch of improvements. They have, so much travel coming in. The airline industry is doing well. So I'm expecting United to also do well. They could have other expenses that we don't know about, but their patronage is going to be up because pretty much every airline has said that so far. Air travel is increasing. So what do we got? Umpqua, that's a bank that I haven't really looked at, so I'm just watching it for fun. And Verizon. Speaking of Verizon, there you go. It's last on the list right here. When's Verizon coming up for when's its actual earnings announcement? So they are 22. So what's that going to be? Friday? Oh, yeah, that makes sense. Verizon usually reports on a Friday. If I'm going to trade a company, I hate it when they report on a Friday. I want a day after they're done to see what the moves end up being. And Fridays can be mixed because people want to get out of their positions before the weekend, or they want to get into positions because they think they're going to miss out. So Fridays are usually hectic. Nice big panics on Fridays can be opportunities to get into stocks you like. Because traders are bringing in the FOMO and all that. They're afraid either they're bringing in the FOMO or they're bringing in the fear. Whatever it is, that's kind of what happens on a Friday. So yeah, they're going to be reporting as well. So that's basically what I'm watching this week. Mostly my if I make any moves, it'll probably be on Netflix and Snapchat because those have the charts that I like. Like I said, we're Snapchat. See, this is what I like. I want to see a chart that looks like this. It's way below its IPO price right now. It's at like $15, right? Is that what it says? $13. Ooh. Yeah, it's kind of in that range between like the 13, 15 areas. So I like it for the future because for whatever reason, even though Snapchat has over 1 billion shares, right? They have 1 point something. I can't see because my mouse pointer is obnoxiously huge, but 1.8. So they almost have 2 billion shares, which is a really big float, and they move like they have, less than 100 million. Right? That's what I liked about Beyond Meat. I was able to do so well on that one because that has like 70 million shares. It's a very small float. So when there's a frenzy, there aren't enough shares to go around and the price just skyrockets. And for whatever reason, Snapchat does that too. I think because certain people are just holding, or large institutions are buying huge chunks, or people were shorting so heavily that the squeeze just causes this huge movement. I really don't know. But I'm watching it because now it's low enough to be interesting. I've got leaps on this thing. I'm considering getting some shares at some point because they always end up surprising. Like, they have bad quarters. Yes, I kind of expect this one to be a bad quarter because they had a pump like 2 quarters ago. I made a good amount of money. This was February, January. Yeah. So this one that happened in early February, I made a really good amount of money on because I was buying through this panic and down here at the bottom. I missed the very bottom day because by that point my position was so far underwater. I was getting emotionally wrecked. So I was just the day before when everything dropped because of Facebook, I just wasn't looking at the stock. That would have been such a good day to buy, but my emotions got in the way. And I didn't want to continue doing the strategy that I had planned because it was hurting. My strategy was to buy on this down move because there could be a surprise on earnings. I mean, look at when these big pops happen. Earnings, giant pop right here. Earnings, biggest pop they've ever had. Earnings, huge drop. Earnings, huge drop or pop. Earnings drop. Like every single time, well, not every single time, but most earnings have these huge reactions. So just in case, this is at a point now where it's cheap enough that I can risk a little bit of money to make a lot of money. And that's what I'm looking for. I want lower risk, higher reward. Those are rare trades. And is it actually going to happen? I have no clue. But this has the look of it, the charts that I like. It has that grocery outlet look. It has that Snapchat look. You know, and Netflix looks the same way. So I'm going to be watching them. I don't know if they're going to move yet. There may not be a catalyst. Maybe Snapchat is getting hit harder than we think by TikTok. I don't know. But they're similar platforms, but they allow for slightly different stuff. But the thing about TikTok is you just jump on it and you scroll and you're done, right? There's no gimmick besides that. All the other ones have a gimmick. Like Snapchat has that whole, you take a picture, it only lasts for 10 minutes and people can use it. They can sell their premium Snapchat accounts and make money. Not to mention they can use it as a phone. So if you don't want to pay for a phone service, you can just have Snapchat and you can call your friends or text your friends in the Snapchat app, which, so many apps can do that now. You can do it with Facebook Messenger. You can do it with whatever. That's just kind of the way the world works at this point. But Snapchat has some utility in that case. That's what I'm saying. Like, people can use it for money. People use it for a phone. People use it as a texting device. There's also the whole thing about adult content. Snapchat has a heavy amount of adult content, and right now adult content works. So I mean, there are things that they do that generate money for people. So there is utility in it. So I don't think it's necessarily going to go to zero. It's maybe not as good as people thought it was. I don't know if it deserved to be up here, but it has a chance to pop, at least to the line that it broke out from. Like, this is again another goal. The IPO line is a heavy area where psychologically people are going to be looking at. So I'm looking at a rise to at least there. It could go beyond. I don't know. It may not even get there at all. I don't know. But I like the odds of a move from here to here. I think that's very doable at some point. There could be some surprise. It doesn't happen every earnings season. So if this one's bad, then next earnings season could be the surprise if one's going to come. So anyway, that's what I'm looking at. Let's get to the crypto stuff. Crypto got a little bit of a pump now. Let's move it on here. Let me pull up the Bitcoin chart. I know it's kind of a quick transition, but I got to get going here soon, so I've got to move faster. You can see Bitcoin, it's still hanging out in those levels. It's got decent support here. It's actually picking up volume now that it's at this area. Actually, let me zoom in a little bit more wrong one, to see what we're doing here. We've had these drops. It's hanging out. So we've been in this range for 1, 2, 3, 4, 5, possibly 5.5 to 6 weeks right here, which is nice. I mean, bears have been saying that it's going to go down even more, which I mean, it might, but it depends upon the rest of the market. Like, Bitcoin is now a part of the market. It was originally supposed to be a hedge against it, but because traders are in it, big money is in it, it's affected by the way the market moves at this point. So it's not a hedge anymore. It's just another piece. In fact, it tracks the NASDAQ relatively closely, which makes sense because the NASDAQ is made up of a bunch of tech stocks, and tech companies want to own did want to own Bitcoin quite a bit during the pump, which actually was a good move for them because they were making more money on something they didn't have to do anything about. Hopefully they sold some of that, but I don't think they did. A lot of these companies are just hodling because that's the smart way. It's hard to trade this stuff, even though I did. I mean, I got lucky on the trades that I made with crypto, but I also didn't get lucky because the points that I sold at were like right where they broke out to go to extreme highs. So I didn't make as much as I could have if I had just held the whole time. So CoinFlex, that was another exchange. They're a smaller one. They're now allowing users to withdraw 10% of their holdings. There it was. Crypto leader Celsius files for Chapter 11 bankruptcy. Okay, so Celsius did. I think Voyager is just continuing to implode right now. They suspended trading and withdrawals and deposits like a couple weeks ago, I believe, along with so many other companies. There was a money manager a couple of weeks ago that was saying most of these exchanges are probably insolvent at this point, which I wouldn't be surprised because they were heavily betting on Bitcoin and other cryptocurrencies, and they needed the market to continue to go up in order to continue their business because I'm sure the loans that they took out depended on it. The business they were getting from users was up because interest was up in the market, and now that interest is down, they're getting hit. They're not getting as many new users. So a lot of these newer, smaller companies are getting crushed. Even the big ones are too. Like for example, let's see, Coinbase got a downgrade to 42 from Mizuho Securities, which may have moved it a little bit, but that's kind of to be expected. They've already been getting hammered with downgrades. Coinbase is at the will of the crypto market and the stock market at the same time. Any of these, companies that are heavily weighted within crypto are going to have that problem. So they've gone down a little bit, but they're still around. The little companies are getting squeezed. And that's the other reason why I don't put my money into smaller exchanges. So I've had people ask me like, hey, what about this exchange? What about this exchange? Oh, I saw this one. I say, I really don't know. I'm not that versed in some of the smaller exchanges, but at this point, with how the market's going and how those systems are set up, I just don't want to risk dumping my money into something that's going to kill me soon. Especially if what happens to a lot of these exchanges happens to me. I mean, most of these exchanges are free. Think about this. You put, let's just say you put a good chunk of money. Let's say you've saved up like $50,000 or something, and you take a good chunk of it, you put it into, I don't know, some cryptocurrency exchange, and you try to make money with it. And this is like, to you, this is all your money or most of your money. Hopefully not all your money. You don't want to put all your money in one basket, but it's a big chunk. And you were doing well for a while, but now you're getting crushed. That is a difficult pill to swallow for some people, and it's going to make people want to leave. But it's also going to clean up the space and allow the prices to stabilize a little bit before we can start going up again, which is what usually happens with this market. If you look at crypto over the long term, it's like the S&P. It continues to rise. So cryptocurrency is a mess right now. I've been buying little bits of it here and there, like all the popular cryptocurrencies like Bitcoin, Ethereum. I have some Litecoin. I have some Bitcoin Cash. I have a little bit of Doge. I'm not, the whole market will pump, so Doge will probably move, but I don't necessarily have faith that Doge is going to do what it did in 2021 anytime soon, because a lot of the luster's out of that. We have to have a mania going on in everything for that to pick up again. That's why Doge was able to do it. If you look at Doge fundamentally, it shouldn't be worth that much. It's infinite. They can print as much of it as they want, which means the people that own it could abuse it if they let things get out of control. And that could happen to any crypto. There is no cryptocurrency that's completely immune from that stuff, but something like Doge runs more on an image than it does actual utility. Although it does have utility because you can spend Doge. You can buy things with Doge. So it's not a complete waste. That's why I don't think it's dead in the water. I think it's going to continue to follow the market. I'm more just looking at the main, like Bitcoin and Ethereum, because most cryptocurrency, the cryptocurrency market is going to follow that. Bitcoin has the most engagement out of all currencies, and Ethereum is a very close second. So most of the attention is within those, or within cryptocurrencies that are on like the Ethereum blockchain or something like that. So I'm watching crypto. I'm adding a little bit of money. I'm not putting my money into weird exchanges because if they're insolvent, they trap your money. So it's not something that I want to put too much into. Like, I don't want to have all my cash frozen. I came close to that one time. I actually had an error with Robinhood, along with a bad trade, caused my account to go to a point where they had to lock my capital up for like a day or two until I was able to say, hey, this is a mistake, and they unlocked it. But if you're in something like Voyager or Celsius or whatever, or something, one of the cryptocurrency exchanges that's locked up your funds, that's an awful feeling. You have no idea if you're going to get that money back. So mostly I'm just trying to buy what I can, buy a little bit on Robinhood, buy a little bit on my crypto account, and see what I get over time. So that's what I'm looking for. Be careful in the crypto market. Be careful in the stock market. That's my main goal. Waiting for the rate announcement next week. Waiting for these earnings to see what happens here. Snapchat, Netflix are two of the main ones I'm looking at. Also the indices. Let's see what they're doing. See if their trend is going to continue. Actually, let's go back to the Qs real quick. We didn't check out the Qs. Yeah, the Qs kind of have a little bit more volatility than the SPY does, just by a hair, not by a lot. But yeah, we're in this range. We've been in this range for a good month now, a little over that. And we're waiting for this Fed meeting so I can see either this trend continuing, because we have had lower high, lower high, lower high, or maybe we finally get a rally at some point. But I don't think we're going to get that rally above this trend until the Fed is announced and a lot of companies have reported. And if the companies report that things are not as bad as they think, that'll be bullish. But what we're waiting for is guidance. That's the big one. So how are companies going to guide? Because last earnings season, pretty much across the board, companies guided down. And that's why you saw this, like this big drop right here came during like a good chunk of that earnings season, right? So we had like the March area. So you start at the end of March, beginning of April, up until May is about when you're in that first quarter of earnings season there. And look at what was happening. Down, down, down. Everybody was saying the prospects don't look as good in the future. The prospects don't look good in the future. The prospects don't look as good in the future. And eventually it just became kind of a zombie drone on thing. Just, we're going to go down. It's going down. And that's what happened with the market. But now that we've had that negativity priced in, and if the Fed comes in and says, hey, things may not be as bad, and the companies are free to guide up again. But the good thing is they wanted to guide down because it allows their stock to pop in the future. So at some point, there's going to be a guidance uptick. And that's what I'm waiting for. I want guidance upticks because as soon as that happens, the analysts will come out the very next day upgrading the price targets, upgrading their predictions on them, and that'll move the market like crazy. Upward guidance, upward analysts, that is the most bullish thing you're going to get. So a Fed that doesn't have to go as hard, upward guidance, upward analysts, higher price targets, all of those things would make an extreme bounce. So how much of that are we going to get this earnings season? I don't know. I'm looking for some turnaround. I kind of think it's going to be mixed. I still think there's a lot of bearish sentiment. So these companies, to be safe, are probably going to have bearish outlooks. So I don't necessarily know if we're going to get this huge explosion. But if the Fed tightens within a reasonable amount and says, hey, things are probably going to be okay, they're looking good at this point, and there's going to be enough release of tension for companies, if they're doing well, to pump the market. So that's what I'm looking at. I hope that makes sense. Kind of been blabbering on a lot of, for quite a while. That's just what I do. I mostly started this channel so that I could do this and get some of this stuff off my chest because I just want to talk about this all the time, but people in my life, they don't want to hear it. They're tired of this stuff. So I'm talking to myself or I'm talking to people that don't care. But when I come on the stream, I get to just let it out, have diarrhea of the mouth, and see how things go because, man, it's nice to get that stuff off here. So we're getting towards the end of we're at the end of the stream, basically. If anybody has any comments or questions or anything you want to say, throw it in the chat. What do you say? Children are so fat. How do we make money off that now? I don't know. There's probably a way to do that, but people's weight, I really don't know. Maybe look into something food related or exercise related because there's going to be people that want to do that. What do we have? Mask Master. I'm listening, dude. Good show. Hey, thanks. I hope I see you back next time. So there's not going to be a show next week, but the Sunday after that, I might be on for like a little bit. I'll probably do like a little thing next week, just giving you a quick update, not really trying to do anything. If you have any comments or questions, then come into the stream, say hey, drop the stuff in chat, and let's talk about it. But the next big one's going to be the Saturday after that. Also, I need to add more links in the description, but I have a link to the YouTube and the Discord. With the Discord's really not doing much. I'm just getting it going. The social media accounts are the same way, so there's not going to be a whole lot on there. But jump on them, and over time things are going to increase. Start sharing that stuff. If you know anybody else that's down to listen to this stuff, bring them into the chat. I really want to grow. The problem with Twitch is it's known as a kingmaker system, meaning the more people you have, the more exposure you get. So the more popular your channel is, regardless of how good it is, the more people are going to tune in. And I know that's true because when I started on Twitch and was looking around before I did any broadcasting, I went to the most popular channels. That was just the natural thing I did. So if you know anybody, bring it up. I got to get these numbers up. That's why I'm focusing on other platforms, especially TikTok, because there's huge growth there. And I want to make little short clips, which is exactly what TikTok is doing. I've got the YouTube in there. That's where I put these. I edit them and I put them there within, a day or two. So that you can actually see these things and get all the ums and the ahs out of it and all the boring stuff that doesn't matter. So yeah, show some support there. Come back on Sunday. Let's talk about it. I got to get going. We've got a very interesting week. I'm going to lay low for most of the week unless there's a good opportunity. But next week, I'm going to be broadcasting the Fed meeting live. If I make any trades, I'll put them on screen like I did last time. Although since I did so well, I kind of don't want to trade because I don't want that luck to run out. But we'll have to see if the opportunity presents itself. I'm going to go for it. All right, so I'm going to get out of here. Everybody have a good weekend. Thank you for coming in and joining me. I really appreciate it. This has been so much fun. I love talking to all of you. Have a great weekend. Stay safe and be ready for the volatility. I'll see you later.